Good morning and Happy New Year. Welcome to Dannible McKee's 24th Annual Nonprofit Conference. We are so pleased to continue supporting our nonprofit community, and we're so grateful that you've chosen us to be with us virtually today. Working out the kinks. There we go. My name is Charlotte Roth, and I'm an audit partner with Dannible McKee. It is truly an honor to serve as your host for this year's conference. We have a strong lineup today of presentations planned, each designed to provide practical insights and tools to help you lead your organization with confidence and impact. Before we dive in, I'd like to cover a few housekeeping items. Throughout today's presentations, we're going to be launching polling questions using Conference IO app. This is new, but we'll work with you through it. We encourage everyone to participate. Please note that if you're seeking CE credit for your attendance, responding to the polling questions is required. If you haven't already, please open the Conference IO app in Zoom by clicking the prompt, signing into the session, and keeping the window open alongside your Zoom screen. If you accidentally close the app or don't see it in a different link to the Conference IO, it has been shared in the Zoom chat, so you can reconnect to that at any time. And if you run into any issues along the way, just let us know in the chat. Someone from our team will be happy to assist you. At the end of my introduction, I'm also going to provide another QR code that you can scan to link up on your cell phone. We also encourage you to use the app to submit questions that you have for the presenters. We will address as many as we can live. If we run short on time, a member of our team will absolutely follow up with you afterwards. Towards the end of the conference, the app will also provide a link to the session evaluation. We greatly appreciate you taking a few minutes to complete it. Finally, all the presentations will be available on our website following the conference. We will send a follow-up email with a link to download the presentations once they're available. Before we begin, I'd like to take a brief moment to share a little bit more about our firm. We were founded in Syracuse in 1978. Dannible McKee has grown into one of Central New York's largest and most respected CPA firms with over 115 professionals, including 24 partners. Today, we serve clients nationwide, offering a full range of audit, tax, accounting, and consulting services from our offices in Syracuse, Auburn, Binghamton, Schenectady, as well as Tampa, Florida. While we're proud of our deep technical expertise, what truly sets us apart is our commitment to understanding each client's unique goals and challenges and delivering a personal and responsive service. We work closely with nonprofit organizations to help improve efficiency, strength, governance, and provide a meaningful insight into the metrics that support their mission. Our team is well-versed in nonprofit accounting principles and board governance issues, and we collaborate year-round with management and board of directors to develop practical strategies and solutions. We offer a full-service accounting support, including general ledger maintenance, bank reconciliations, grant vouchering, financial statement preparation, along with support of QuickBooks, QuickBooks Online, and other accounting platforms. Now let's get started with our first presentation. Let's take the dysfunction out of your functional statement, presented by Peggy Rowe and Angela Janak. And my team just reminded me that we're also going to switch over to the QR code right after I get through the introductions of Peggy and Angela. So don't worry, we've got you. Peggy Rowe, she's an audit partner with the partner in charge of our accounting and advisory services department. She brings more than 30 years of experience overseeing audit and accounting and advisory services for a wide variety of organizations with specialization in nonprofits. Peggy is a graduate of Lemoyne College, a certified public accountant, a certified fraud examiner, and she currently serves as treasurer of the Central New York Diaper Bank. Presenting with Peggy is Angela Janak, a senior audit manager with more than 11 years of experience providing accounting, audit, and consulting services to a variety of our clients with a concentration in the nonprofit sector. Angela is a certified public accountant and has earned her bachelor's degree and MBA from the State University of New York at Oswego. graduating summa cum laude. She is currently the president of the Syracuse chapter of the New York State Society of CPAs, treasurer of the Syracuse chapter of the Accounting and Finance Women's Alliance, and founding member of the Syracuse Women's for Good. Please join me in welcoming Peggy and Angela, and we're also going to put up that QR code for you to scan for Conference IO. Please remember, if you need CPE credit, this is what you're going to need in order to answer the polling questions. All right, welcome Peggy and Angela. Good morning. Here we go.
Good morning, everyone. So Angela and I are so glad that everyone joined us for our session. And as Charlotte was going through everything, 24 years.
24 years.
24 years. And I think maybe I've spoken at every single one of them, other than maybe the first one or two. So it's been a good long stretch here. So what we're going to talk about during our session is, let's take the dysfunction out of your functional statement. As we were going through and trying to figure out the different areas to talk about this year, one of the good things is the FASB hasn't put a lot of additional guidance out. They kind of left us alone here for a little bit in the last couple of years. So we decided that a good topic would be to talk about your functional statement. And can we get the right thing on the screen, please? Yeah. Okay, so our outline that we're going to be talking about is the functional expenses, and we're going to talk about the who, the what, the why, and the how. The how, talking about, there we go. Talking about the, they had the tax part up there for me, and that's not my area.
You've done this for 24 years. You could probably teach that.
Maybe. I have a little bit of experience in that, enough to be a little bit dangerous, but I'm not an expert.
We'll leave the you, but to Shannon.
Yes. So, and then the fourth one was how. So we're going to talk about the direct identification and allocations. We're going to talk about the allocation methodologies. Angela's going to go through and talk more about how to track your expenses and the tools to do that. We're going to talk about the common pitfalls and best practices. So one of the things that we talk about too when you talk about functional statements is that although there are some direct allocation methodologies or you're directly allocating expenses, but there's also a lot of estimation in here. So you could have a lot of allocations. Are you trying to get it go forward?
So I see in the chat that we have some concerns about that QR code again. We will note that as we do the polling questions today, each polling question slide will also include that QR code. And that QR code does take you to the same area as the login for the link that was shared by Dannible. So that dmcps.cnf.io login through your browser. So don't worry, that QR code will appear periodically throughout our slides. So let Peggy get into the who of functionals.
The who. Okay, so all nonprofits must follow the AISBA accounting guidance on functional expenses, including but not limited to charitable organizations, 501c3s, nonprofit healthcare entities, churches and religious organizations, private foundations, and other nonprofits. So there was I don't know how many years ago it was that the FASB put out guidance. The functional statement was not a required statement for all entities, but they thought it was important enough and made it a requirement for just about every nonprofit organization. So what is a statement of functional expenses? Okay, so your functional statement presents your allocated costs to the readers of the financial statements. Function defines the purpose of an activity, a purpose or activity, and expense supports typically categorized such as program services. So, obviously, as a nonprofit organization, your main goal is to provide program services. You may have one main program services, or you could have multiple ones that would be meaningful to disclose in the functional statement. The next one, the two remaining ones are the management in general and fundraising, and those are your supporting services to the program services. One of the things that that we didn't put in here, and it's I don't see it very often, but the FASB does have some guidance on a 4 category for membership. So if you are a membership organization, there's the potential to break it out into membership as well. The next area, nature and natural classifications, refers to the intrinsic type of or substance of a cost. So examples include salaries, rent, depreciation, office supplies, etc. So like when you're looking at your functional statement on the left-hand side, you'll see all of your natural classifications of your expenses that have been either directly allocated to your functions or some sort of allocation methodology. Okay, so your functional statement may be presented on the face of the statement of activities. So if you're a small enough organization and you can actually fit it there, it is allowed. You are allowed to put it in the notes to the financial statements, or its own statement on the face of the financial statement. So typically what we do, not always, but it depends on the size of the organization and the financial statements, but typically we would have a separate functional statement. Note, including the statement on functional expenses as a supplemental schedule to the financial statements does not meet the reporting requirements. So we used to do that when it wasn't required, sometimes having as a supplemental statement, but that does not meet the requirements at this point. Okay, your functional statement may be presented comparative or with prior year summarized totals. So what that means is when you're looking at your functional statement, and it can get quite large sometimes, you'll have your natural classification, you'll have your programs, management in general, fundraising, and a total for, let's say we're doing 2025. And then if you repeat all of those columns for your programs, your management in general and fundraising in the prior year category, that is considered to be fully comparative. The guidance does allow you to only show the current year and have all those columns, but also, and then just have a total for the prior year. So that would be with prior year summarized totals. So, and if you choose to do that, if only presenting prior year summarized totals, the notes should indicate that the statements should be read in conjunction with the prior audited financial statements from which the information is derived. So you'll see typically in note 1, a disclosure on that, just letting the reader know, there is some further information. Go look at last year's financial statements if you want to see the details. Okay, nearly all expenses should be included in the statement of functional expenses as program management in general or fundraising with a few exceptions. So these are a couple things. So we have the investment expenses, the gains and losses, the cost of goods sold, and the cost of direct benefits to donors. Okay, so the investment expenses. So the FASB has guidance out there that internal and direct internal investment expenses that have been netted against investment return should not be included in the analysis of expenses by nature and function. So really when you're looking at your statement of activities, your profit and loss, investment income is the expenses are directly netted against that. So therefore, since it's up in the revenue section, you're not going to show it in your expenses down in the functional statement. Okay, gains and losses. So certain items that are typically excluded from net income of for-profit entities, such as those items listed in FASB's ASC 220, 10, 45, 10A are considered gains or losses, and like other gains and losses should be included in analysis of expenses by nature and function. should not be. I think I said should.
Yeah, should not be included.
Okay, so examples, gains and losses on investments. So you'll always see those up in the revenue section, regardless of whether it's a loss, which you would think, okay, that's an expense, but it still stays up under the revenue section. Gains and losses on foreign currency adjustments, and then gains and losses on post-retirement benefit obligations.
And there is a very comprehensive list in the guidance, if you all feel like doing a little bit of light reading. So
Angela's gonna take over. There we go.
We're gonna talk a little bit about cost of goods sold. Many nonprofits that we work with don't have cost of goods sold, but there are organizations out there, I know, that are providing services in exchange for compensation. So according to the FASB guidance, and you can see the exact reference there, the cost related to sales of goods and services, how they're displayed depends on whether the sale is a major or central activity of the nonprofit or peripheral or incidental activity. So of the main activity that your organization does, are you mainly being paid for services directly provided to individuals for their own benefit? Or are you, maybe you have a gift shop, whereas your main purpose is to educate the public via a museum? So whether or not it's major is going to determine how you are going to present them. So, for example, a nonprofit museum that has a store that is a major or central activity should report and display separately the revenues from the store sales and the related cost of sales. Cost of sales is permitted to be reported immediately after revenue from sale of merchandise and may be followed by a descriptive subtotal, or cost of sales may be reported with other expenses. As I go through these ifs, I am going to have a few slides to show you some examples of how this looks. So if the store sells merchandise that is related to the museum's program, the store would be a program service, and the cost of the store's sales would be reported as a program expense. So is that museum selling stuffed toys, or is that museum selling educational materials? In other circumstances, cost of sales could be reported as a separate supporting service. For example, if operating a cafeteria is a major essential activity, but it's not related to the nonprofit's programs, the cafeteria cost of sales would be reported in supporting services. So maybe you're a very large nonprofit that has a cafeteria that serves your employees, but is not open to the public. That would be different than if you operated a cafeteria at a childcare center for the purpose of feeding the children. Next, we're going to talk about direct benefit to donors. This is another area that has some nuance. Here we're talking about benefit to donors often during fundraising events, but we'll go through the specifics here. So as discussed in the Q&A section, 6140.08 from the AICPA, the functional category of the cost of direct benefit to donors that are not program related should be reported as a separate supporting category, such as cost of sales. If the benefits are provided in exchange for transactions, they should not be reported as fundraising. So what do I mean when I say an exchange transaction? An exchange transaction is when you are providing a service or a good to the public, to other organizations, and the individuals are getting a direct benefit, as opposed to a activity that is for the greater good. So if the donor benefits are provided in transactions that are not exchange transactions, such as a fundraising dinner for which there is no charge to attend, the cost of donor benefits should be reporting as fundraising unless they are program related. So this is not a exchange transaction because the purpose of that dinner is fundraising. Some nonprofits conduct joint activities that are special events, such as symposiums, dinners, dances, and theater parties, in which the attendee receives a direct benefit. So they're getting a meal, they're getting a theater ticket, they get to see a show, they're getting entertainment. and for which the admission price includes a contribution. So in that case, the contribution revenue is shown net of the expense that was a direct benefit. We see this often with golf galas, golf tournaments, in that the individuals are attending, they're paying a fee, but they're also getting that direct benefit that is the experience that is the gala, the beautiful golfing on whatever course CNY has to offer. So here we have a few different examples of how that direct benefit to donors can be shown. So in case A here, you can see there are contributions of $200. There's special event revenue of $100, and they're backing out the direct cost of benefit to donors right above, right below that special revenue line. So it's showing up net in your income section. Down below, you can see net revenues from special events of 75, contributions and net revenues of 275, etc., to get you down to your total expenses. So in that case, you are backing out the cost of benefit to donors just below your special event revenue. In case B, you have revenues, contributions of 200, special event revenue of 100, total revenues of 300. That direct cost to benefit to donors is actually down below in your functional under program, direct cost benefit to donor, management in general, etc. So whether or not it's going to go net or whether it's going to go down in your expense category depends on if it's incidental, if it's major, and the nature of the fundraising activity. In case C, the contributions are shown of 270. There are dinner sales of 30. You're backing out your direct cost of benefits of 25. So in this case, your contributions are higher because there was a contribution included in the ticket to the dinner sales. And that's the difference between contributions of 200 and dinner sales of 70 versus contributions of 270 and dinner sales of 30 compared to contributions of 200 and direct cost of benefit to donors of 25. So really how your scenario looks is going to depend on your organization. And if you're not sure which scenario you would fall under, you would want to consult your accountants. We'll talk later about different ways you choose how to allocate. A big takeaway is always to consult with your accountant if you're not sure of what your presentation should be. Here we have an example of what your statement of functional expense may look like. So in this case, you can see the natural classification that Peggy was talking about. So when we say natural classification, we're talking about what actually is the expense. So like we mentioned, salaries and wages. Other items in here might be meals and entertainment, occupancy. Some organizations may choose to show rent expense on its own separate line. Some organizations may choose to show utilities and other occupancy all grouped into one line with your rent. The purpose of this is really transparency to your readers. So if you're just using a very general category like program expenses and office supplies, and those are your only two lines, in general, you would need to do some work to break out more detail there. Along the top of this example, you can see program services, management in general, fundraising, and in this case, they did an example where they're showing the direct cost of benefit to donors down in that expense area. So this is a comparative with summarized prior year comparative information. So you can see here the current year is all broken out in detail, and the prior year just has totals. That is one of the options we were talking about earlier. So we're going to go into our first polling question. Again, these are required if you want to receive credit today. The QR code is up again. The link is also typed out in the chat. So let's hear your thoughts. Which of these costs would be excluded from my statement of functional expenses? So which one of these shouldn't be on your functional expense statement? You've got your credit losses, formerly known as bad debt, your depreciation expense, salary expense, or loss on a fixed asset. One of these things is not like the other, even though a couple of them may seem similar. Just a few more seconds. We've got some poll results coming in.
They were listening.
Congratulations. We have a smart group with us today. You are correct. The loss on the sale of fixed assets should not be included in our statement of functional. So in this scenario, any kind of loss of fixed assets is going to show up on your income side, on your revenue side of your statement of activities, and therefore not in your functional expense. Credit losses actually do show up in your functional statement, but whether the nature of the credit losses relates to direct program services or administrative non-program services would determine whether it's management in general or whether it's program.
Okay, now we're going to answer the question of why. So why are we doing this? It's required by generally accepted accounting principles. So ASU 2016-14 presentation of financial statements of nonprofit entities requires not-for-profit entities to report expenses by nature and function. And as Angela mentioned a couple of times when she was talking, it's about transparency. We're talking about allowing the readers to understand the impact of their donations. It helps grantors to assess the fiscal responsibility of the organizations. It improves reporting for board and management oversight. And it's also required for the IRS reporting. So Form 990 requires 501c3s and 4s organizations to report the breakdown of expenses between the three classifications. So it's just, it's really about the transparency. It's about, when you're looking at the functional statement and you're trying to show what your organization is all about for purposes of trying to get more contributions in, trying to get grants in. These organizations or individuals want to see what you're spending your money on. So they want to see that you're spending more money on your program services rather than on your supporting services, management in general, and fundraising. So the how, the methodology. So there's a couple different areas. So our allocation methods, the direct identification or a reasonable allocation. Okay, so direct identification is the preferred method whenever possible and practical. So it involves allocating actual expenditures incurred related to a specific program, supporting service, or grant. So just keep in mind, like, let's take salaries. If you take a look at the duties of your individuals and your staff members, what are they doing? They may be 100% program related, so that makes an easy allocation to program for them. And it may be their salaries, their benefits, and various other items. Reasonable allocations. There are times where direct identification is not possible or practical. When determining which method, consider such factors as do costs benefit multiple programs or functions? Do costs of tracking for specific identification exceed benefits? Are total cost categories material? Or are costs specifically defined by the accounting guidance? So there's a lot of different ways that you can do allocations. I think when we see in our audit practice, depending on the organization, if it's a smaller organization, they may not do a whole lot of the allocations. They may just kind of rely on us at the end of the year to do an overarching, let's take salaries and, allocate it between like the 80% program and 20% management in general. But there's really a lot that goes into that. So you could have it as simple as that, or there's could be a multi-pronged way of doing your allocations.
Yep, and we'll go through that in a little more detail later. But right now we're talking about just the reasonable allocation methods.
So the objective methods of allocating expenses are preferable to subjective methods, and the allocation may be based on related financial or non-financial data.
So what do we mean when we say objective methods? We're saying that these are items that we know belong specifically to this program. If it's an invoice that was purchased for a specific event, it gets allocated to fundraising. If it's purchased for a specific project, for a specific grant, it gets allocated there, as opposed to that, I think it's about this percentage at the end of the year. It's always a estimate. Judgment is going to be involved, but anywhere you don't have to guess is more beneficial to your readers.
Okay, so common allocation methods, time and effort reporting. So I know we get a lot of pushback sometimes with this, but our recommendation would be having some sort of timesheet for your staff to really detail whether they're working on program management in general. So time sheets or activity logs. You can use headcount or full-time equivalents. You could use square footage for occupancy. But also keep in mind too, if you have a staff person who is part program and part management in general, when you're allocating them their salaries in that way, if they have their own office and we go and look at the square footage, this is where you might get into a little bit more detail, is that we have to do it based upon the square footage overall for that office. But if that person that's in that office is being split between program and management in general, then we also have to do another allocation. So it can get a little bit complicated, but those are the best practices on how to do it. So direct usage or consumption, percentage of revenue or transactions processed, or as I was talking about, the hybrid or layered allocation approaches. Okay, selecting and applying allocation methods, matching the method to the nature of the cost. Having consistency across the period. So, as you go from year to year, yes, you can make changes, but it really should be pretty consistent going from year to year. Documentation of the methodology and the assumptions so that everyone knows how that's being done. Periodic reassessment and updates, and avoiding overly complex or unsupported methods.
So we're going to go through some of the common costs and allocation bases that some of your organizations may see. So starting out with your personnel costs, we've touched on those a bit. That would include things like your salaries, wages, payroll taxes, benefits. Depending on your organization, we most often see salary as one line in your functional, and then employee benefits and taxes in another line. How you do your presentation really depends on the materiality and circumstances of your organization. And when I say materiality, you might go, well, what do you mean when you say that? We'll talk about that a little later. But in general, materiality is what level of cost do I think is going to affect the decision-making of the users of my financial statements? Am I a small organization and every dollar counts? And if I have an error, the user of my financial statements cares if we have misallocated $50. Or am I a multi-billion-dollar organization where $1,000 is a drop in the overall bucket? And it doesn't matter if it was reported to salaries when actually that was a tax expense. So with that in mind, how are we going to allocate these costs? Personnel costs, a common allocation base is time and effort reporting or job duty estimates. Many salary and payroll providers actually provide function tracking where you can allocate your employees to a department code where your payroll register will just give you the total hours, and then you can split your costs accordingly. Some reports will actually summarize, so you'll just get your totals by those departments that you set up. Other notes are best practices in this regard. Salary and personnel costs are a very high audit focus. Later today, we will be talking about preparing for audits and best practices. So just keep in mind, salaries are highly scrutinized often. Documentation is critical in that respect. Looking at occupancy costs, as Peggy was mentioning, square footage is common, could also be headcount by area. That could include rent, utilities, insurance maintenance. So if you are allocating your rent by your square footage, it might make sense to take those same percentages and just apply that percentage to your utilities. Square footage is preferred when it is distinct. If you have a lot of multi-usage areas, then it might get a little muddy. In that case, maybe you want to consult with your accountants. Information technology might include software, hardware, IT support. So how do you allocate those? Maybe you do it based on users, number of devices, usage metrics. Your allocation base is really going to be based on your cost driver. So are you paying for software per user, by the hour? Are you buying one item for the entire organization? Are people sharing devices? Those circumstances are what's going to drive your cost base. And your best practice is to reflect actual usage. Any one of these best practices, we want to keep in mind what's practical. It may not be practical to track every minute your individuals are using their laptops. Looking at professional fees, such as legal, accounting, and consulting, common allocation bases here are direct assignment or time spent. Avoid allocation if identifiable. What we mean here, if this is a directly identified cost, if you know this is for management in general, if you know this is for a project, don't just apply that same percentage you've been applying every year. If you have one direct cost that's large, identifiable, maybe you pull that cost out of your cost fee pool before you apply that percentage to the rest of your smaller items. Looking at additional cost categories such as human resources, that could include recruiting, training, HR services, and systems. Common allocation base would be your headcount or full-time equivalents. Best practice there, proxy for level of HR support. Finance and accounting could be your accounting staff, could be audit costs, and could be allocated based on transactions processed, time spent. A note there, audit fees are often management and general expenses. Later, we'll talk about best practices and common pitfalls. One thing to note here, your functional statement should be presenting the fact of the function. If an audit is an administrative requirement, it's going to be a management and general expense on your functional allocation. Does that mean you can't allocate it to your grants? Not necessarily. Your grant accounting will have rules that are communicated through their contracts. We talked about contracts a lot last year. Your contracts will tell you maybe you are allowed to bill audit fees. You want to make sure that you're tracking how it's recorded in the general ledger, how is it recorded in your vouchers, and just keep detailed documentation if there's any kind of disconnect between where it's allocated in your accounting system compared to how it might show up on your vouchers. Looking at executive management, CEO and leadership costs would fall under this category, and are often based on time and effort estimates, and they're often partially allocable. So what that means, there's going to be a portion of executive management that will always be management and general, with few exceptions. And the rest would be allocated between your programs and fundraising based on that time and effort. Looking at your depreciation, examples of that would be your furniture and equipment, building depreciation, maybe you have vehicles, and that can be allocated based on asset usage, square footage, So asset usage, perhaps you have a vehicle that's rented for the use of your program. You can allocate that based on square mileage if that is split between program and administrative usage. Square footage for things like the depreciation of your building. This should be consistent with how the asset is used. One last common allocation list here. You have insurance that could include liability, director and officer, and property insurance. So common allocation bases there might be your payroll, headcount, asset value for property insurance. So you're going to match the base to your risk driver. So for example, your professional liability insurance, maybe that's allocated based on the number of employees with certifications compared to total employees. Looking at office supplies, including supplies and postage, that might be included, allocated by headcount or transaction. Again, always apply directly where identifiable. Printing and copying, that might include your copier leases, printing services, that could be allocated based on your usage logs, estimated volume. Simple estimates are acceptable as long as they're consistently applied. The trick in all of this is balancing a need for transparency and knowledge of what your expenses are doing for your organization with the practicality and time spent of actually tracking these things.
There's a question if you want one.
All right.
What is an example of bad debt expense that could be considered programmatic?
So that could be, I'm thinking immediately of childcare, where perhaps a portion is paid by DSS and another portion is paid by the parent. Maybe a parent doesn't pay. It is part of the main program. I think that would be a good example.
Yeah, I think if it's specific program specific, related revenue that's being written off, I think that would be.
Yep. And we do have a few more seconds for the poll question here.
There we go.
So looking at the poll we just had up, what method would be most appropriate to allocate salaries? And you all chose based on hours worked on programs or activities as a percent of total time, and that is the preferred method. I see a small portion of you chose the 100 program because that's what donors like to see. Well, it is true that our donors, the donors out there, like to see program. We want to make sure that we are making the decision, that management is making the decision, to actually spend the time on the programs. Just don't say we are, make it a reality. I see a concern that a screen froze on the last poll. There are 4 polls throughout the presentation. So long as you answer 3 of them, you will get full credit. And if you have technical difficulties beyond answering 1 full question, certainly reach out to us in the chat and we can discuss what we can do for you. So next we're going to go over how to track your expenses. So in this so a minute ago we talked about the allocation methods. Here, what tools do I use to allocate items? So common tools include Excel, QuickBooks, and other ERP systems. Today we're going to talk a lot about QuickBooks because it is the most common used with many of our clients, but there are a lot of ERP systems out there with a lot of good options. So Excel is a valid and valuable tool, but manual calculations can be difficult to track. Anytime the organization can utilize programs designed for expense tracking, it minimizes the chance for errors and increases efficiencies. Where you can automate, do so. QuickBooks class and customer functions are a great way to track your functional expense. And most systems have other class, project, or a similar function. Contact your service provider if you need additional assistance. So your internal expense tracking is important. It allows the organization to track your expenses among funding sources, which we talked about last year a lot about grants, evaluate your programming, ensure there's no double dipping on grant expenses, and preparing your statement of functional expenses. It makes it quick and simple at year end. So in QuickBooks, there's a report known as your profit and loss. For not-for-profits, those are your statement of activities, a report that shows revenue, expense, and net income over a specific period of time. It is the essential financial statement for nonprofits and crucial for demonstrating how well you're doing. It can help you categorize your revenue and expense to identify the need to adjust your programming. In QuickBooks, there's also a statement of activities by customer, also referred to as funding source. So each funding source can be set up as its own customer, and income and expense can be allocated to that specific customer. So this is an example of what a profit and loss by customer or funding source would look like. In QuickBooks, you would set up your grants as a customer. You would set up your general fund as a customer. And while this is setting up for grants, oftentimes by tracking your expenses this way, you can also see if it's a grant, it's for a program, is it for management in general? By using both the class system and the funding source system, that gives you a way to track what I was talking about earlier. Maybe your funding source allows you to charge management in general, but for your statement of functional expenses, that needs to be shown not as a program. So we do give you a description of how to add customers in QuickBooks step by step. Our presentations will be available after the conference, available on the Dannible website. So feel free to look at this step by step. And here we have a screenshot just showing you how you would add that customer in QuickBooks. You go to customers, you go to your new customer, and it'll walk you through the prompts from there. Then I mentioned the statement of activity by class, also known as program. So each class should be set up, each program should be set up as its own class, in addition to fundraising having its own classification and management in general having its own classification. And here's an example of what that looks like. So again, we have the directions to add your classes in QuickBooks. So feel free to go through these after the presentation. Our accounting services department is also QuickBooks Pro certified and can assist as people need. So here you can see to add classes in QuickBooks. In your invoice transaction, there is a class module on the lower right where you can select an existing class or add new, in which case you just follow their QuickBooks prompts. QuickBooks Online does have a great online how-to. If you Google how-to anything in QuickBooks, you will almost invariably end up in their help with screenshots available. So we have our next poll, and we've got 40 seconds for you all to get your answers in. Hopefully we don't have too many technical difficulties on this one. So how does your organization track expenses? Are you tracking it by nature and function? Are you tracking it by funding source? Are you tracking it by all of those items? Or are you going, I'm going to ask my accountant at the end of the year. They got this. I'm going to hope for the best. We've got some answers coming in. We have one clear leader, but I'm seeing a little more diversity in these answers than we historically have. I appreciate the honesty there. Just one more second. All right. So it looks like the majority of you are fulfilling the requirements both to track for your statement of functional, and the funding source will help you with your grants, which we spent a lot of time on last year. A lot of you are halfway there. For those of you who recorded to ask my accountant, thanks, you're keeping us in business. So next we're going to go through your common pitfalls and best practices.
Okay, so the common pitfalls. as we wrap this up. So we over allocating to programs without support. So obviously, when you're doing grant vouchering or looking at your functional statements, you really looking at it, a lot of people want to like do as much to program, but just keep in mind, it's not necessarily you got to do what is right and what the data is showing you. Inconsistent methodologies year over year could be a problem. Lack of documentation, not documenting what you're doing, not keeping timesheets, not having the square footage all documented. All of that stuff needs to be documented, so that if somebody comes in, maybe a granting organization comes in and wants to do some testing of the allocations, I mean, that you actually have the documentation available for them. Treating allocations as an afterthought. So again, it shouldn't necessarily be an afterthought. It shouldn't be, let the audit firm figure that out at the end of the year. Misalignments with actual activities, confusing indirect costs with program costs, and over complicating the allocation. So there's a cost benefit relationship to this. So trying not to overcomplicate it. Okay, confusing indirect costs with program costs. Certain grants will allow organizations to charge overhead to the grant to recoup operating costs. This does not inherently mean a cost is a program cost. It's important the organization establish guidelines to identify and track those costs for grant reporting when they may be reported as management in general for the statement of functional expenses. This is a benefit of using both the class and customer functions in QuickBooks. Documentation, so best practices, documentation, maintain detailed records to support the allocation methods. Consistency, use rational, repeatable methods. Oversight, have independent individuals review a member of management, supervisors, or an outside accountant. And having establish a written policy for allocations, i.e. an internal accounting manual, memos, or standard allocation worksheets. So some more best practices. Expense allocations are a management estimate and some judgment is required. So we've talked about that. A lot of the portion of the functional statement is an estimate. There's always judgment required in this. So there's not necessarily, sometimes, in looking at your judgment, as auditors, as if you have this judgment and that's what you can kind of prove to us in the thought process, and then we would go with that. The level of detail needed to allocation expenses will depend on your organization's needs, including grantors' expectations, the needs of your board of directors, the trustees, materiality, and available resources. When in doubt, consult your accountant.
We did mention how there are some organizations that will just go through their expenses at year end and say, okay, I think my office supplies are about 75%, and I think my rent is about 40%. One thing we'll note, estimates are okay. Ballparking those percentages is okay if it's based on legitimate data. The trick here, you shouldn't just be looking at your expenses and say, everything is 50-50, everything is 70-25. You should still at least be going to a level of detail in your estimates that you are considering each line of that natural classification separately as you are doing your estimates. So we have our last poll of the day. We do have the QR code on the screen again. You can use that or log in to the DMCPAS link in the chat to answer. We've got about 30 seconds left to answer this poll. So after listening to this presentation, your organization needs to go back to the drawing board. For the most part, you've got this, maybe just a few tweaks, or you're actually perfect. Now, I don't know about y'all. I would love to see some perfects. I don't know if we've ever found a perfect organization, but some of you are rock stars, and we are here to help those who need a little bit more. Our poll's up in just a second. And it looks like for the most part, you've got it, but just a few tweaks. Those of you who are perfect, we would love to work with you. We'd be happy to do your audit.
Okay, conclusions and takeaways. The statement of functional expense is more than a compliance requirement. It provides accurate tracking and thoughtful allocations are critical. Assist management and the board in decision-making and strategic planning. Strong policies, consistency, and transparency build trust. Provides key information to current and prospective grantors and your donors, and continuous improvement opportunities. Oh, we have about 3 minutes left.
So we'd like to open it up if anyone has any additional questions. Say definitely. Thank you all for attending today. We've got a great slate lined up for you. Our additional presenters are going to be available for questions as well as us. So if you've got a Q&A, put them in the chat via the app or Zoom. We do prefer that you put the questions in the chat. We have one question about the polling again. So if you've got those kind of issues, we can make sure that you are putting your name into your inquiries so we can work with you. Just be aware throughout these presentations, there are about 4 per presentation. So just look alive on those. So thank you for your time today. We're going to turn it over to our wonderful MC.
Thanks. Great job, ladies. Thanks, Peggy and Angela, for such an insightful presentation. Hopefully, it sounds like a lot of you are on the path of not being dysfunctional in your new year, so that's good. So now it's my pleasure to introduce our guest speaker who will be presenting From Missions to Metrics, Building a Stronger Case for Impact. Unfortunately, Melanie Littlejohn experienced an unexpected emergency and will be unable to join us today. That said, we're very fortunate to have an excellent guest stepping in for us. Joining us today is Frank Ridzi, Vice President for Community Investment at the Central New York Community Foundation. Frank has played a key role in launching and leading community initiatives focusing on literacy, lead poisoning prevention, poverty reduction, and economic inclusion. His work has been published in a variety of academic and professional journals, including Foundation Review, Journal of Applied Social Sciences, Journal of Organizational Change Management, and Review of Policy Research. Frank holds a master's degree in public administration and a PhD in sociology from Syracuse University Maxwell School, as well as a certificate of advanced study in women's studies. Prior to joining the Community Foundation, Frank served as the director of the Center of Urban and Regional Applied Research at Lemoyne College, where he continues to teach as an associate professor of sociology. Please join me in welcoming Frank. Yeah.
Okay. All right.
So you.
Thank you. I'm not used to being ahead of schedule.
I mean, we aim to please here.
It took 12 accountants to get me on time, so I appreciate it. Punctual nature. So I'm glad to be here. Welcome, everyone. Hope it's you're appreciating the rain instead of the snow today. So today, I'm filling in for Melanie, who's a fantastic colleague, and I'm sure this presentation will be a lot better, but let's see if we can have some fun. This topic, From Mission to Metrics, you might be wondering, why do we have a non-accounting presentation here in the middle of this? And really, if you were listening to the last presentation on fund statements, it's the same reasons, right? The accountability to donors, accountability to grant makers, accountability to your board and those who are exercising oversight, it's all the same reason. But even more important is because you want to have numbers in those 990s. You want to have numbers in those audits. You want to have numbers in your financial statements. And to get those numbers, you have to raise that money. And we know that you know what it's like to do your day-to-day job. You know what it's like to help people's lives. You know what it's like to help get that pet adopted. You know what it's like to feed that family. You know what it's like to help that person get that first job, perhaps. But how do you explain what you're doing in your everyday work to somebody who's a bit removed? somebody a little bit like me, right? A donor. I'm a donor. I'm a volunteer, or a fund manager of a foundation who's going to be figuring out whether or not to award a grant to your organization. So that's really what we're here to talk about today, and the importance of incorporating metrics. And there's one thing that I'll repeat. Somebody who's a legend in this community, B. Gonzalez, likes to say, I hope you, if you're around B, I hope it's okay if I quote you, that stories move the heart and data move the head. And a lot of this is going to be talking about how do you move both the head and the heart to get people to be part of your mission, to donate, to volunteer, to be on your board, and to make grants to you. So that's the topic for today, for this session, from mission to metrics, building a stronger case for impact. So that being said, just a little bit, you had a bio about me, but the perspective that I'm really going to take here is that perspective of someone who's a bit separated from your mission, somebody who's a potential donor, a potential grant maker. I volunteer with a lot of nonprofits. Assume I'm not a volunteer at your organization. And so this cartoon kind of gets to it. You have Charlie Brown, and I think it's Linus, saying, I think Linus saying, when I get big, I want to be a great philanthropist. And then Charlie's saying, well, you have to have a lot of money to be a great philanthropist. And he thinks for a second, he says, well, I want to be a great philanthropist with someone else's money. And so we get a chuckle out of that, because really that's what philanthropic professionals are. We are people who are professionals, and what we do for a living is we help honor people's legacies long after they die. And so it could be 100 years since someone's death, and we're still looking at the things they cared about in their life and giving out money for those activities. And so that's the type of person, that's the type of audience that oftentimes this is for, as well as, of course, your living donors and volunteers. And so this is important because you want to move the head and you want to move the heart, and you want to encourage these people to make contributions to be part of your mission. So a little bit of an overview of this. So why metrics matter? Because you want to move the head and the heart, right? The stories are very important, and I think people are good at storytelling, but you can be better at storytelling when you connect the numbers and the story. Because soon after telling a story about an impactful event that happened, or working with a client and how their life really changed, the donor, the grant maker wants to know, well, how widespread is that? Is that just one person? Is that a one-off? Or is that something that really happens to a lot of people? Second important is connecting mission to measurement. You really want to measure things that are about the central core things of what you do. And we'll talk about that, and not sort of going down rabbit holes of things that are easier to measure, but really don't speak to what makes your organization unique and makes your organization the best place to donate, the best place to serve on the board, the best place to volunteer, or to make a grant. So storytelling, as I'm mentioning, is very important, and it's connected to those KPIs, those key performance indicators. You want to think about how you're going to tell that story. What's the story behind those numbers as you're doing that? And we'll give some examples as we go. And then you want to align those with your strategic goals. It's not just your mission, but where you want to go as an organization. What types of things do you see changing in the community with your organization when it's fully funded, when it's fully operational, you're fully staffed, and you have all the resources that you need to do that work? And then we'll get into some practical tools for immediate use, things like logic models and dashboards. Take a look at those, because oftentimes they say when you're learning another language, say you're doing learning French or Spanish or Farsi or something like that, you really know it when you start dreaming in that language, and really to start getting fluid and fluent with this type of KPIs. You want to see a lot of examples. I would really recommend looking at examples, look at peers. So you start dreaming in these terms, and you start thinking, oh, this is how we could show our impact. And then you can start moving toward doing it and carrying it out. So we're going to start then with the challenge. The challenges that nonprofits have, basically because they do work. We know, I do a lot of site visits, volunteer a lot of organizations. And this is an amazing community. This is Central New York. There's 5-county region. I know that you're broader than that as well here on the audience. We do a lot of amazing things, and people day in and day out come and they give it their all in nonprofits. But it's often very difficult to summarize that for someone. And, if you're a donor, you know this. There are many, many people reaching out to you, asking for donations. And it's hard to sort them out. It's how to figure out, you only have so much to give. Same thing if you're a philanthropy. Even the largest philanthropy in your community probably can only fund about 17% of the amount of money requested. So it really is competitive. So we oftentimes have a problem where there's many activities. You might have, if you're a small nonprofit with a few staff, one CEO, and maybe some volunteer staff, you might describe yourself as a chief cook and bottle washer, right? Meaning I do everything in this organization. And we hear that a lot. And everything means a lot when you're living in the moment and you're serving all the clients that you have. But it's hard to explain. It's hard to count. And oftentimes this leads to inconsistent data collection. You have many organizations, I walk in, I'll say, oh, what's your data? And they have Post-it notes here and there and things like that, or a bunch of disconnected spreadsheets, or some stories that really don't have any backup evidence, not only about the actual incident, the actual point of service, the actual life that was changed, but also about how widespread that is. And that's very, very important, right? If you are good at, helping people's lives improve, right? You want to know that you can do this for a lot. And everyone knows that story about the little boy walking along the seashore, picking up all these starfish that have washed up, right? And somebody's walking saying, there's millions of starfish here. How are you can't possibly save all these starfish. How can what you are doing matter? And the boy picks up one and throws it and he says, well, it mattered to that one, right? He's returning these starfish that have washed up on shore back to the water where they can live and survive. And so that's an example of a story that moves the heart, right? You really can help out, that starfish. But when that's moving the heart, but when you want to move the head, you want to be able to say, well, how many starfish did we actually get in? How long does it take to get them in there? What is their survival rate when they get back in? And those things start to matter when you're competing with others who are also returning starfish into the ocean, right? So your metrics start to matter, or perhaps somebody who says, we're returning, clams to the ocean, right? Something like that. And so really it is a market out there, and those metrics really need to be connected to your mission. And so it's clear what you're doing and how your organization really fills a niche that no one else does. So why metrics matter? They strengthen fundraising, right? If you're able to say, this is that story about starfish, and this is how many people we help in this way, it really helps with fundraising. It improves the programs. You're able to hire better staff. You're able to train those staff. You're able to take best practices from your high-performing staff and transfer those to others. Builds trust within the community. When people can see, when you're transparent about what you're doing, not just when you are doing well, but also when you're doing poorly and not hitting those key performance indicators, as we'll get into, that's also builds trust. And that's a secret that you might not know. And for me, 17-ish years working in the field of philanthropy, can say it builds trust just as much when you tell the truth about what you're not achieving. So, we tried to get these 20 people jobs and we only got 7, and here's why, and we think we're doing this wrong. That builds a lot of trust. Just as it would in a relationship when you're honest, right? So building trust is important. So measuring isn't just about telling a good story. It's about telling the true story. It's about showing that you are committed to the outcomes of your clients more than you're committed to just raising funds or keeping your organization going. It shows that you care about the mission more than you care about the institutional structure that you built to achieve that mission. And that's what donors and funders really want to see. So you want to demonstrate that accountability. Absolutely. You want to be able to show your board what you're doing. You want to be able to reallocate. And they say in the entrepreneurial world, fail early, fail fast. It's not that different in the social entrepreneurial world. When you're working with people in the community to help make their lives better, it's not easy, right? It's not as easy as selling widgets or counting widgets. You're really dealing with all the things in their life, right? You've heard of the social determinants of health, right? So if you're just trying to make their health better, you've got housing, you've got gun violence, you've got lead poisoning, you've got exhaust, you've got all sorts of things. It's a complex world out there. And so what works is going to be complex. And this allows you to show we're really interested in failing and failing fast so that we can get quicker to a better solution. So demonstrating that accountability is very important. Also, guiding your strategic decisions. Sometimes you're going to hit on something that really works, that's really popular. There are constantly changing needs in the community. And so if you're able to show these metrics, you're able to say, you know what? The people coming in don't need this anymore. We're going to shift over to another line of service. Or we've been trying to get people jobs for a long time, but it's not working because we don't have childcare. Well, maybe we need to pair and bundle childcare, which you heard about in the last presentation, with the job training programming. And so it'll help you in those ways when you gather these metrics. So, all right, so on to our first question. First question of this presentation: which of the following is not a reason that metrics matter? Is it because it would strengthen fundraising? Is it because it would improve programs? Is it because it would remove barriers to data collection? Is it because it would build trust within the community, or is it because it would demonstrate accountability, or finally guide strategic decisions? So which of these is not a reason that metrics matter? I'm telling you that metrics do matter. They help to move the head along with the heart. And so which one of these is not a reason that they matter and not a reason that we're articulating? It'd be helpful. If you're not doing it now, start doing it. And you've got 5 seconds left. I think people are responding. Okay, they are. Oh my gosh. All right. All right. So which of the following is not a reason that metrics matter? So it's not the first one, strengthening fundraising, because if done right, it can. It certainly can also help you improve your programs and build trust in the community and demonstrate accountability and guide strategic decisions. So yes, most of you picked remove barriers to data collection. So now that I've told you it's good, are there barriers to actually doing it? There are, right? So many of you pointed out that just knowing that this is helpful doesn't remove the barriers, and there are barriers. So next, we're going to turn into what are some of these barriers to data collection. So the next slide, we'll shoot over. The first thing is people often they aren't necessarily aligned always with their mission. Sometimes you hear this called mission creep or mission drift, and that's oftentimes looking for grant money, right? It's a fact of life that you need money to keep the lights on, keep the staff here, and oftentimes what we end up doing is looking for what grants are out there, and then going for those, right? And so the key things to remember in this is that you want to align your activities with your mission objective. So you don't want to go for monies that aren't aligned with that. It's hard. It's a stiff discipline, and sometimes it can mean that your organization is shrinking at certain times. And so that's something really you want to perhaps sometimes change your mission if there isn't a market. Second, you want to identify measurable outcomes, which we'll get into, and a lot of this is going to be showing you examples of measurable outcomes and right-sizing those measurable outcomes, picking ones that really hone in on what you do, because sometimes people say, well, I don't serve individuals, I serve the whole community. Well, there are outcomes for that as well. And use data to tell the story of impact. So there's the mixture of data and storytelling. You want to pair those together and almost use the data as the skeleton, right? Use that skeleton and then put flesh on that so people can really see, oh, I see, it looks like a human, and I see what the flesh looks like as well. So you're really using that metaphor, filling in the skeleton of the data with the actual stories, and then ensuring relevance to stakeholders, right? Making sure that what you're doing, the stories you're telling, the things you're measuring are relevant to those donors, those volunteers, those board members, those grant makers. So those are the first things. So one thing that you often see is a process. This process, if you've done any sort of evaluation, or if you've ever run a program, this is a very popular process. This is a results-oriented management and accountability cycle. So everything I share here kind of assumes that this cycle is going on. And the first thing at the very top is assessing what the community needs. You can see how that is a part of accountability to the stakeholders, because you're looking to see what are the needs of the community right now, not when this organization began, and you're looking to modify what you do in relation to those needs. So you might notice Micron is coming to your town, maybe a big company is coming to your city, and something that you didn't realize before is now a big need, like housing. Oh my gosh, we need a lot of housing. We need a lot of childcare. We need STEM programs to help kids get into those jobs, right? So those assessments of needs, that's very important. We'll get into that in a moment. Lead into a planning, what my organization is going to do. It really should relate to your mission statement, or you need to maybe revise your mission statement. You don't want to do that too much, but you want to sort of make sure that you're always doing things that are aligned with that. Then leads to figure out what your implementation plan is going to be. What are you going to do, right? You can't do everything, right? You're just one organization, but you'll notice that we'll get into something called the logic model later on. Things like logic models can be very helpful in figuring out what strategies you're going to engage in to get the results that you want to see to really address those needs that you identified in the assessment. Then the next step is achieving results, and that's achieved through you figure out what exactly is happening. You start measuring things, and then you get into evaluation, which is the last part of this. You're analyzing data to compare that against benchmarks to figure out, are we really getting as many people employed as we thought we could with this approach? And at that point, two things could be wrong. One, your theory could be wrong. Maybe giving people a car or childcare doesn't isn't enough to get them into employment. Or two, maybe you're giving them broken cars. Maybe you're not giving them satisfactory childcare, right? So it could be the theory's wrong, or it could be the way that you're implementing the theory. So evaluation is helpful for both of those things in evaluating data. Wanted to throw this out there because this is very important for community action programs. They're in every community across the country, and this is really something that the federal government and others have embraced and put forth as an approach. The thing I do want to point out, though, is when you're looking at evaluation, right, that last part that I pointed out, it's really critical that you identify the right things to evaluate. And you can see here with this image, right, you've got all sorts of arrows pointing to this one thing, that one red dot. What's that one thing that you really care about, that your organization does better than anyone else, that you're going to focus your efforts on? It could be getting people out of poverty, getting people out of homelessness. It could be getting stray animals into a loving home. It could be helping people just find their next meal and ending food insecurity. It could be helping youth explore reading or what their love of books or animals. That one thing is what you need to be crystal clear about. And you need to focus not on the outputs, which is how many people you serve or how many children you serve. If you think of yourself as a computer or maybe a machine making widgets, making widgets, how many widgets you make, right? That was my impression of a machine, right? And used to have a professor that was saying the world is a machine. He had a very strong accent. The world is a machine, and I was like, yeah, it's a machine. What does the machine do? What the machine does is make widgets. That's outputs. That's how many people you serve, how many meals you serve. That's helpful in talking about how the machine is running. But what you really care about is, does that machine serve a useful purpose, right? You've heard about these machines that are whimsical, that kind of do funny things, that they don't do, they work nice and smoothly, but they don't actually make something of value in the world. That's something of value in the world. That's what we're talking about when we're talking about an outcome. An outcome isn't just somebody's getting meals served. It's how many people have food security now? How many people are not malnourished? How many people are no longer homeless? How many people have a job? How many people are thriving? How many people are moving up Maslow's hierarchy of needs, if you're familiar with that? If you're not, I'll show a slide in a little while that talks about that. And that's what we really care about, people's lives changing. And that's, that you might say, well, how does this relate to my audit, my 980? It does, because when you're able to tell this story, the rest of that is about how well you do what you do. But nobody wants to give to you if you don't do something that they care about, right? So that really points out that these also have to be measurable. You also have to be able to quantify them. And we'll talk about how you do that in a moment. And aligning those with your strategic goals of where you see the organization going and where your organization fits into the broader fabric of the community, right? We're an ecosystem. Just like if you go to Baltimore Woods, if you go to your favorite nature place, you'll notice that the birds, right, the flora, the fauna, they all kind of work together in an ecosystem. Where do you fit into that ecosystem? So not trying to do everything right here, not trying to take credit for what other organizations do, but being really clear about your contribution, right? I'm a bee, I pollinate, right? That's what I do. All day long, I pollinate. Well, not all year long, right, but all day long when in season, right? So you're clear about that. Mission statement should also say what you do, what you don't do, right? So you're prioritizing what matters most for your stakeholders. So let's get into that. So KPIs, they can help you measure performance. They can help you, once you are clear about that, and then we're going to get into some examples in a moment, right? So if you have never seen a performance measure, a key performance indicator, I've given you some hints as to what they are. It could be the number of children who receive books and are improving their reading, the number of people who get jobs, the number of dogs who now are in a loving home, right? That's a KPI. So these can be used to measure performance. You can use this to measure who are your top performers, who are you going to reward, and more importantly, who are you going to encourage others to emulate? For instance, I really love the way you work with those in the methadone clinic with people who have meth addictions. You really connect with them. I love how you're doing it, and I can see it in the declining rate in which they're using drugs. And then you're not only praising that employee, but you're then saying, what are your secrets? And you're generalizing that, and then kind of spreading that around to others. You're going to expand that to other staff. It can help you align your strategy and actions, and help staff do that. Well, they say measure what you treasure, and they say if a tree falls in the wilderness and there's no one there to hear it, does it actually make a sound? Same kind of thing. If you do something great and no one measures it, did you actually do it? Right? You did. That's the answer, is you did. But it's not, the donors don't know you did it, right? The volunteers don't know you did it. The board doesn't know you did it. And so this helps staff to align their actions, right? And they, hopefully, when you build these, you pull them into the process and allow them the opportunity to say, I think this key performance indicator is not quite right. How about we tweak it this way? And you say, yeah, how about we tweak it that way? And you do that collaboratively so that you are building in the wisdom from the frontline staff, the staff that are working with people day in and day out, because that's where a lot of the wisdom and a lot of the theory really can be built. So aligning, and it helps them align their actions. You're facilitating decision-making, again, with those staff, the program managers, the frontline staff, and the C-suite. What should we focus on, right? What are we doing well? Motivate those employees and identify new opportunities, right? Some risks, though. Sometimes you can pick inappropriate indicators or things that people don't understand, and they end up doing the wrong thing. Why are you doing that? Well, because the indicator said so. Well, that points out you really need to develop these indicators with people, right? You need to have as part of a conversation. Or maybe have two indicators. I was part of an initiative, and I said, I'm glad to join this initiative. What are we doing? And I don't want to say the name of it, but they said, this is what we're doing. And they produced a list of about 40 data points, 40 indicators. And I just looked at it, and it was like, I got a little dizzy. It was kind of like, if you're old enough, you remember in the newspaper, they used to have something called the magic eye. It was just a bunch of blurry colors. And you look at those, and if you look long enough, a shape pops out. And you can say, oh, that's a camel, right? It was a little bit like that. It was overwhelming. It had this sort of narcotizing effect where I didn't know what to focus on. And so too many indicators is also a problem. So don't over measure, right? Only measure something that you're going to use in decision making. So if you look at something and somebody's saying, should we keep this in the database? You could say, well, have we ever made a decision on that before? Have we ever looked at that number and said, let's go left or right? And if you never have, say, are we ever going to? If the answer is probably not, get rid of it. Don't waste people's time. People know when their time is being wasted. And if your time is wasted, what are you going to do? Probably the same thing as me. I'm going to say, you know what? They're wasting my time. Nobody's looking at this data, and I'm going to do this, but 0, 1, 0, 1, 0, 1. People start entering stuff. You get sloppy data. I wouldn't encourage that. I wouldn't do that, but there's a temptation, right? So don't overmeasure. There's a chance that things can be misaligned, right? That data can be manipulated. You want to make sure that you are using those data to capture what's actually happening, right? There's a big debate about whether SATs, right, or GREs actually, or standardized tests actually measure intelligence or learning, right? And so that's a debate about whether the tool is actually managing what they're saying, right? So that's something you want to really think about. Do those measures measure what you actually say you're measuring? And it's called face validity and things like that in the academic world. So pressured by KPIs often involves stress. Sometimes you don't want to stress out your staff, right? This should be an opportunity to learn, and you should celebrate, right? And they do this in the Navy. They do this in a lot of places. Let's celebrate our failures. Let's have an after-action review and talk about what didn't work, because it's more important that we figure out what didn't work than that we hide it and sweep it under the rug and keep doing it, right? So this shouldn't be something that causes stress among staff, right? It's a team sport. There's a team goal, right? It's not about firing your kicker after. Oops, sorry, is it too soon for that for the Bills fan? Sorry about that. Anyway, I don't want the crowd to turn against me here. All right. So anyway, only figures. You also want to make sure you're also measuring what's not measurable. So conversation and stories, as we'll talk about, are important as well. All right. You've probably heard this before, so I'm going to fly through this. Just wanted to be in the slides. What you measure should be SMART, which is specific, right? It should be something that's pretty precise. It should be measurable, something that you can actually ask people, something that you can collect data on, and something that's achievable. You actually can get it to happen, something that's relevant. It has to do with your mission, as we were talking about, and something that's time bound. It's set a deadline for how long it will take. So if you were to say, what we're going to do in this nonprofit that we're going to resettle lost dogs, right? There's a lot of dogs that are walking around and they're lonely and they don't have families. And what's our KPI? When we get these dogs in the homes, we're going to bring about world peace. You say, what? Is that specific? Like, what do you mean? What do you mean you're going to solve a conflict somewhere? Like, what part of the world? Is it measurable? How are you going to know if you did it? You're going to ask the dog owners? Is it achievable? Like, is that within your reach? Is it relevant? I mean, that's not really in our mission statement. And is it time bound? Like, maybe it's possible that if you get enough dogs into people's households, the level will increase so much that eventually people will lose their desire to war. and we will bring about peace. But you can see that's not a smart example, right? Something, and oftentimes we don't go that high, but we do kind of. We say, I'm going to end poverty. I'm going to end homelessness. I'm going to make these children have great professional lives. Well, they're 4 years old. How are you going to do that? It's not time bound, right? You're not going to be able to follow them for 20 years, right? So what oftentimes we mean by this is picking something that's sort of on the way to that long-term goal. You may want them to have great professional lives, but what you have to do is then say, well, what literature says is if you thrive in school, you'll have a great professional lives. And then what literature says is to thrive in school, you need to be able to read by third grade. When they stop learning how to read and they start requiring you to read in order to learn. That's where they stop teaching you this is how to do the phonics and sound it out. And that's where they say, here's the history chapter, read the textbook and learn. So you might say, oh, all right, I'm at 3 and 4 years old, I'm not going to get them to the profession. So that's not a smart measurement. But I can say, you know what, I'm going to get them reading on grade level by third grade, right? That is within, it's specific, right? You have a test for it, it's measurable, it's achievable, it's relevant to what you're doing. Say your literacy program, your book distributions, right? And it's time bound. You can measure that by third grade. Or maybe if that is too long a time, you might say, you know what, I'm going to bring it back to kindergarten readiness because that predicts third grade reading. And third grade reading predicts high school graduation. High school graduation predicts college, predicts career, right? So you can use literature to do it. You can have lofty goals. I'm not saying don't try to bring about those goals that you dream about. Just when you pick your measures, be very specific about where it fits into that chain of events, right? So that's a smart measure. All right. So you might be thinking, where am I going to find these measures? Well, I mentioned Maslow's hierarchy of needs. If you've never heard of Maslow, don't worry. This is what it is. It's a hierarchy of needs, a pyramid that starts on the bottom with your basic needs. And the basic premise of this is if you don't have the lower needs met, you can't move on to the upper needs, right? So for instance, I'll look at this, I'll say, you know what? I'll look at the top of the pyramid on the left. I really want to transcend myself. I want to self-actualize myself. I want to be, as a sergeant used to say, I don't want you to be, I had a sergeant, I won't tell his name. He said, you know what, you gotta pictualize where you want to be, right? Picture yourself and actualize yourself. You want to be all you can be. And as Sarge, I can't do that when my feet are freezing, when I don't have food, right? That's the physiology, right? And so you have this sense where you got to do the bottom. You have to have food. You have to have a house. You have to have a roof over your head, shelter, before you then get into safety and security. And then you need to belong before you can have self-esteem. And you got to have that self-esteem before you can start learning and have this cognitive advancement. And then you move into aesthetic and self-transcendence. So the idea is you need to get the bottom in order to get to the top. And so why am I going into psychology and Maslow's hierarchy of needs? Really because this is a nice crosswalk into what your program does when you're thinking about your mission, right? Kind of talking about the niche that you serve in this community. So maybe you have to do with physiological, you do proper nutrition, or you do housing. Maybe you do school and neighborhood safety, you're in safety. Maybe if you're in belongingness, you do community programs, or self-esteem, you do empowerment programs. This all comes from Arthur Brooks, former professor at SU, I think he's at Harvard now. This is from his textbook. I see the citations not visible here, so I want to give credit there. But maybe it's aesthetic, so you help people with the arts, right? Etc. Or maybe self-transcendence, and you help to create mentor programs when you're measuring the effect on the mentors and the mentees. And so this gives you an example, and you might say, all right, well, I got a sense of you've got these basic needs that tells you where you fit in the niche in this larger organism of the community, right? And I got a sense for where my organization fits. The next step is to take this and then translate it from these needs and these solutions to what actually might KPIs look like. And so here you got a bunch of examples, right? So your physiological needs is your food, your drink, your oxygen, your temperature regulator, your elimination, rest, activity, right? And safety needs, protection from dangerous objects, situations. Maybe it could be, lead poisoning, things like that. So when you look at this, you can kind of get a sense of, all right, what could I maybe measure? And more on that as we go. I'd say the hardest part of all of this is not the technical parts, it's picking your measures. Really it is. Once you've got your measures, other people can show you how to do it, right? And there are actually some tools, some free tools, at least if you're in the 5-county area around central New York, that are free, that are available. But I'm happy to talk with anyone who's looking for ideas. So these are good examples. I'm not going to go through all these, but you can take a look at these and get a sense. There are people who talk about strategies for this, and I know because this is Zoom, I figured I wouldn't zoom in too much, but you can see that they talk about measuring at the top part activities, attendance and things like that, and quality of service. Those are outputs. Then they move into short-term outcomes, cognitive change, right? Think of something, this is what schools do all the time. Did a person learn something from pre to post, right? That's your Regents exams and things like that, right? You've got affective change, right? I used to think that drugs were cool, and now I think they're not. The DARE program, right? Now, is it possible that can get wrong? It actually could, because the early evaluations of DARE, even though they had the Stingray and they had the really cool Corvette, they studied it. DARE to keep kids off drugs was the program, and I'm just not talking out of school, to sort of quote the research. It said, what happened after kids were in those programs, and it turned out that actually, wow, they did more drugs, right? And so when you look at that, you realize, all right, it's not that keeping kids off drug is a bad proposition. That's a worthy thing to do. The way we're doing it isn't quite working. Maybe we're introducing kids to drugs they didn't know about, right? And kind of figuring that out. So affective change is that change in attitude. And then the key thing is behavior change, right? After this program, I got a job. I kept a job. And just on the news yesterday, they're talking about the methadone clinic, and they're having different approaches. One was they say, no drugs right away, and we're going to, and the only measure is drug, whether you're clean of drugs. But another approach that was competing said, you know what, we're gonna be flexible and help you get off this slowly. And what was interesting was the behavior that was changing wasn't actually. They weren't necessarily getting fully off drugs, but they were able to sort of manage that in a certain way where they were able to actually help out and get a job, acquire a car, have a home. So there was interesting things. So you really got to be careful about exactly and what exactly your changes are, right? And be specific about it, because sometimes it could be not the one you set out to achieve, but something that's kind of related. And then you've got long-term changes with organizational and programmatic, and I'll get into that later. But I just want to let you know that there are things out there that kind of give you, it's a sort of a cheat sheet. And when you think about, well, do we want to change knowledge? Do we want to change people's attitudes or their behavior? And so there's a little bit of zoom in there. And oftentimes, if you're going to change cognitive, you're going to do some sort of a test of knowledge. You're going to say, can you do this skill now versus could you do it before? A pre-test, post-test. If you're going to do affective change, you're going to ask people about their perception, their attitudes, right? So this is sort of a foreshadowing to later in the program where we talk about surveys, and there is a lot of ways to survey, and that is a very helpful tool. And then altered behavior. You look at actual observations and even self-reported. Did they actually change what they're doing? Did they actually quit smoking? That kind of thing. So if you're into karate or the martial arts, you might think of these are the areas of that you're going to karate chop with your program, or these are the areas you're going to help: knowledge, attitudes, awareness, and motivation. And so, just to quote Peter York here, oftentimes, and he's somebody who is in the field studying nonprofits. The goal is no longer homelessness or eliminating disease. And he's going to reiterate something that I kind of shared earlier. Such goals are inspirational. They absolutely are. They are almost always beyond the direct reach, though, of a single intervention or program. It is more realistic, for example, to measure whether clients in a program to help the homeless actually follow through with a job referral or a doctor's appointment, right? These are the initial steps. Such goals may sound less inspiring, but actually represent a significant achievement. And I'll add in here, right? This is where you pull in the literature and say, if you do that, you're on the path to recovery, right? This is where you pull in that other literature. This is where you pull in all of academia. Academia is your friend. All that research is your friend. Pull that in and cite it and say, these are the precursors. These are the foreshadowers. These are the predictors of that type of behavior. And as he further says, this is kind of saying they're SMART goals, which is what that slide said earlier. They are building blocks for achieving broader social change 1% at a time, and they are within reach, right? That means they're smart. They're the building blocks. So thank you, Peter. All right, so being realistic is key there, right? And so here's an example of KPI framework you might use. And we're getting ready for a quiz, right? When it starts getting simpler in a presentation, quiz is coming. So the area, you've got your area, your output metric, your outcome metric, and your strategic alignment. So you've got, for instance, you have a program reach would be the number of participants. That importantly is an output, right? It's like a robot number of people served, right? But oh my gosh, my mind is just blown by this art exhibit, this art program that you did. Now I can't wait. I'm just excited about life, excited about a career in the arts, right? That is an outcome metric, right? The percent showing improvement. So maybe that's affective, right? Oh, your perspective on the arts, your perspective on STEM. I used to hate numbers and biology. It seems so boring, but now I can't wait to work in a factory that makes space for computers and phones, right? So that's a change or an improvement. That's the change. So that's an example of an output versus an outcome, and that's aligned in this case, perhaps with your community engagement. How many people you're bringing into this concept, right? This idea of art or this community engaging people about STEM. Fundraising, dollars raised is an output. Number of donors retained, right? Because that's a long term. If you're in fundraising, you're trying to win people over, then keep them, then lift them, right? You donated once, you heard of lie buns and side buns. You donated last year, but not this year. Side buns some year, but not this year. You want to gain them over and then keep them giving every year and then elevate their gift. You gave $10 last time. Could you give 25? So that donor retain might be this long-term metric, right? It's more long-term looking. Advocacy, number of events you have. I'm having events about lead poisoning and making sure you test your home, make sure it's clean of lead. And then the metric might be, well, we're actually going to create a policy, right? To make sure that if you are going to rent a home, it has to be on a rental registry, and it has to be dust swiped for lead before any children move in. Sound familiar? It does if you're from Syracuse. All right, so mission impact. So you're going to sort of be protecting these children, and you're having financial stability and engaging the community in your mission. So I think we are ready for a quiz. So I can rest my voice. The scanner is right there. Which of the following is not an outcome? Which of the following is an outcome, not an output? So here we're looking to see can you tell the difference between an outcome and an output? And it's sometimes tricky. If you're in fundraising, you might think of this slightly differently than if you're in designing programs. But what people often care about is your ability to deliver when it comes to those key outcomes for community. And once we do this, we're going to start shifting a little bit more concretely into, all right, let's pick some. Let's look at some examples. Now that you know the difference between an outcome or output, hopefully, it's looking like you do, right? And the majority do, that the percent showing improvement is a good example of an outcome. All right, so we're going to move on to the next one. So now that you say, all right, we want outcomes. We're not going to go through this whole chart. Put it in there mostly so you can refer to it. There are different levels at which you could have outcomes. You can have it at individual levels for specific clients. You can have outcomes at organizational levels, like the whole organization is improving. You can have outcomes at the inter-organizational level, meaning these organizations are working better together than they used to, or at the whole community level. And that one is probably the thing that's most intuitive, like, oh my gosh, the graduation rates are improving in our community, right? And so let's get into them. So let's see if we can figure out which one this is. Actually, you can tell because there's a tile right there. It's an example of an individual. This is from something down here. These are all local examples, right? These are the percent of children ready for kindergarten as assessed by letter naming fluency, which is how many letters you can name in a certain amount of time, which is a predictor of ability to read over time. And so what you can see here is not in the program is on the left, and consistently in the program is on the right. And hopefully you can see that the individuals in the program on average are doing much better with that score in terms of 61% of those are ready for kindergarten versus only 46% are not ready for kindergarten. And so just something there to point out, funders, donors, we don't expect it to be 0 and 100, right? That's not real life. This is an example of real life. This comes from an academic journal. Here's another example. Maybe your outcome is having to do with a training program. And so this is a person's ability to use Microsoft Excel, which you saw in the previous presentation, or use a logic model, which we'll get to, or a pivot table, or using Microsoft Access, something like that. You can have a pre-score on the left and a post-score on the right, and then your percent increase. That's another example of an individual performance. And this is an example of self-reported. That previous was an example of an actual test that was administered. Or an organizational level, and I know that you're closer to your screen than I am close to this screen, but here you can see that these are different best practices of an organization. And this is after organizations went through a training program and they had multiple staff from that organization. And what you can see is that the number of, or the percentage improvement in those different functional areas. And this one is very similar to that cycle that I showed you earlier, like looking at needs, developing measures for the approaches to address those needs in the community, and then solving those. So this example, this one might be a little easier to see. This is performance analysis and program adjustments. This is comparing ourselves to others. So if this comes from McKinsey or Kinsey. There are two different, one of those is a consultant firm, the other one was a researcher who was kind of controversial. And if you know it, you're probably chuckling to yourself. I can't remember, but I think it's
McKinsey capacity.
McKinsey, thank you. All right, so McKinsey is the group. And so this one is, are they comparing their organizations to others? Are they comparing, incorporating data into decision-making, or are they measuring performance, comparing ourselves over time, right? So these are organizational level performance improvements. Another one could be organizations that are having to delay funding or delay programs due to funding and things like that. So this would be another example. Are those the number of organizations that are having to scale down their services? Are those decreasing? All right, what does it look like for inter-organizational? Here's a partnership between the county, a literacy coalition, and a lead coalition, where the county is providing data on high neighborhoods of lead poisoning. The Literacy Coalition is working to look whether children that are signing up for their book distribution program in those are in neighborhoods with high lead poisoning, and then asking those families, hey, you're in an area of high lead poisoning. Is it okay if we refer you to the Lead Coalition? If they say yes, then the Lead Coalition is saying, all right, well, we'll walk you through how to test your home before your child gets poisoned. This is an example of inter-organizational working together. So what does a KPI look like here? It might look like referrals, right? And so how many children are being referred? How many people are getting their homes tested? How many kids are having lead poisoning prevented, right? So this is an example. I'm going to show you a series now of, all right, so what does this look like? We're moving from KPIs in theory, as you've seen, into measure. And one thing that I like to point out is it should be kind of easy to measure. It's easy to read a chart. You can see from this, you might not know what this is, this referrals, but you can see if it's in the red, it's probably bad, right? And you can see, oh my gosh, July and September weren't so great. We didn't have a lot of referrals. If it's in the green, it's pretty good. And if you look to the right, you can sort of see things like baseline changes. How much better are we than the initial starting point? So there's an example of that. Here's an example of that last level, the community level. And this is third grade reading. Remember I mentioned that that's in some places, some people say it's an urban myth, but I actually heard Governor John Hickenlooper, I was in Colorado, and he said, he was former governor of Colorado, said, governors are looking at third grade reading in order to forecast how many prisons we're going to need, right? And so, it's a meaningful outcome, right? If you're not reading on third grade level, you're probably not going to graduate from high school and such, and we're going to need more prisons, which is a scary thought. And so there's an example of community need, and you can see this is our community here, Syracuse City, which was very low, 2014, et cetera. And you can kind of see it going up, trying to catch up to the county after some interventions. Here's an example of that same thing on a live dashboard. And you can see, you might say, there's a story behind the curve. Here's where stories are important. Well, what happened in 2020, 2021, 2022? There was a pandemic, right? So third grade reading really went down. And so good news is 2025 numbers are up to 27%. So we are back on track and going up. But so that's an example. You see that with the green is on the top, right? And so when you're thinking about how to measure these, and that's part of what we're moving into this section on, well, how do I measure these? We'll point that out as a best practice. Make it so it's really easy to understand. You can tell that higher is better because higher is greener, right? On this one though, lower is better. This is lead poisoning. This is 2 census tracts in Syracuse, right? This is we're looking to see whether the percent of children who have elevated blood lead levels. That means they've been poisoned by lead, right? And so you could see in 2020, wow, it was pretty high. And you can see it moving down to yellow, and you can see what this group has decided. Well, success is 10%. I mean, obviously 0 is always going to be preferable. But what would be success for this initiative? And maybe we need to do something else. But keeping things tracked this way, is an example of how to do your KPIs, where people can rally around it and get really excited about, oh my gosh, the number, it's still in the red, but we can see the current trend is moving in the right direction. It went down 3%, right? Which is the way we want to see it going. So there's an example. So strengthening impact strengthens this strengthens the impact of your storytelling. When you pair this together, and you can see here that in these, you see on the very bottom of this chart is a story behind the curve. You always want to tell that story. You want to say, well, this is what was happening. It allows you to elevate those stories from, there's this one child, right, which is who was from a refugee family. They got out of war. They fled. They had to leave all their belongings and loved ones behind, and they got all the way to, they made to Kenya for a while, and they had to live there for a few years, and they finally got the note that they're coming to Syracuse. Wow, that's wonderful. And then they showed up, and then they're in the land of opportunity, and then they all got lead poisoning. And like, oh my gosh, what a heartbreaking story. That's the individual story, right? And that's important to tell. But then you're going to be saying, well, listen, in that neighborhood, there's a lot of lead poisoning, and this is what we're doing in that neighborhood. We're helping families like them, right? And it allows you to tell the story, but also when you saw the pandemic, to sort of give the story behind why this is happening across a bunch of people. Well, the pandemic hit and we weren't able to do this, or there was a housing shortage, so we weren't able to do this. So that story is also very important. So we're going to be moving into sort of, so combines the data with human stories is very important. It allows you to do this on this meta level, not just the individuals, but also on the trends in the community. Using visuals to make tangible impact, right? Those charts hopefully give you a sense of whether we've got momentum, we've got the wind behind our backs, we're improving, or if we are so far off that we are not going to actually, we're not going to make any change here. And you see two examples there where they are actually having positive improvement. Highlighting measurable change is very important. It's important so donors can say, you know what, I want to bring that to zero. If you were, think about this, have you ever been to Saratoga racetrack or any racetrack and you see horses? Imagine you didn't have to bet at the beginning. Imagine you could bet halfway through the race. All right. Imagine you could do that. Would you take the opportunity? Why wouldn't you, right? If the goal is to win money, or in this case, to help children not be poisoned by lead. So why are you more likely to pitch in and put your money in if you already see your horses in the head? Yeah, right. So if your team or your horse has got a running start and it's doing well, it brings in more money, right? People want to be on that momentum, especially if you're not into the green zone yet, right? If you can see, we're not to the goal, but we have the wind at our backs. We are doing the right thing. What we're doing is working. We need your resources. People are more likely to jump in, including funders. So highlighting measurable change is very, very important. And then telling stories for the audience. I'm going to give you an example in a moment here with some of these charts where we actually are able to drill down to specific like electoral neighborhoods and things like that. So when you're going to an elected official and they used to be called pork or pork barrel legislation, now it's called congressionally directed funds, right? So those kind of earmark type things. Hey, this is a big thing in your jurisdiction. Can you help us out with that, right? And then that becomes helpful. It helps everyone. It helps their clients. It helps the audience, the people you're trying to serve in their district. So choose simple charts. I hope those seem simple to you. They seem simple to me. Over complex ones, highlight trends and changes, which I was trying to do. Keep labels clear and concise and use consistent colors. Red should always be bad. Green should always be good. Yellow somewhere in the middle, right? So use things that people learn with driving, things like that. All right, another thing, there are tools out there. You can geocode things very quickly and free. Batch geo is something that I was showing somebody the other day. You can put a bunch of addresses in there and code them. And so geography is very important. We live our lives in geographies, right? Donors do too, board members do too. They want to be able to see where that impact is being made, see that neighborhood. So geography is very, very important, very, very helpful. And so to summarize, before we kind of go into a few more examples, right? You're wanting to link KPIs to your mission and vision. You want to report progress regularly. And to do that, you want easy systems. What percent of time should you spend measuring this data and putting it into charts? Not more than 10%. Really don't spend more than 10% of your organization's time measuring these KPIs, right? It should be the lower the better, right? As long as they're meaningful. So you want to report it regularly. You want to have it just kind of churning out. You want to spend most of your time, 90% of your effort, making the needle move, 10% measuring the needle, right? If you think of it as a needle on an odometer. So adjusting strategies based on results, that's why you want to do it. You want to be able to look at these things in real time and make changes. That's why we call it a dashboard. If you think of a dashboard on your car, if you see that gas meter going into E, you take action, you pull over. You see the engine heat going up too high, you pull over, right? You let it cool down. Maybe that's just my car. Anyway, so you communicate alignment to funders and board, and you show them how you're doing this, and you pull this in, right? Because you have the wisdom of crowds. You're leveraging then your board's insights, so they can actually say, all right, I can speak macro. I'm not going to get in the weeds, right? And they say a good story rule of thumb for board members is what is it? Eyes in, fingers out, something like that, right? Take a look at what make sure you can see what's doing, but don't meddle. Right. And this is a way that you can really bring board members in and have them participate and leverage their knowledge and really give your organization your all. So we're going to kind of round out here with some tools, right? We mentioned logic models. We mentioned dashboards and scorecards, surveys, assessments, and CRM or data management systems. We're just going to talk about these. This is something that the Central New York Community Foundation helps organizations with, and we're happy to give free advice on this. So you can always reach out to us. What kind of system should I build? Oftentimes you're like, oh my gosh, I got a new grant. It's for a year. Should I invest in a system that's going to take me 12 months to 6 months to implement? No, right? You should look for a cheaper one, right size. And so we can give you tips on that. So let's talk about this. What is a logic model? Logic model is part of a 3-stage process. A lot of this is going to start to seem like review because it is. We're taking what we built on earlier and we're just kind of giving you examples as we kind of phase out of this presentation, right? You start with the community need. Oh, a lot of people need that, whatever that red thing is. Then you move into a logic model. These are the steps you're going to do. This is the action you're going to take. So this kind of cycle is a sub part of that other cycle that you saw earlier. Then you assess, see how that kind of connects back in, right? So this is sort of a simplified version of that earlier thing, right? So how do you assess? There's lots of ways to assess. You could do brainstorming. You can conduct surveys. You could do all these interesting things. I threw this in here because it was out of the box. And I thought, you know what? These community forums and other ideas for stakeholders. I thought this would be fun for you to look at on your own time. It's getting kind of close to the weekend. It's hump day. And this could be something you print out maybe and take a look at and then go to their website for the weekend when you're bored. Another thing you might have is a community indicators website in the 5-county area surrounding Central New York. We have CNY Vitals. It's 100% free. You might look at this and say, oh my gosh, this number is, who's the biggest group living in poverty? Oh my gosh, it looks to be females at that age, which I can't see without, I must need corrective lenses for this distance. 18 to 24. Thank you, 18 to 24. Thank you, see that. So this might be how you identify need. The need is among women who are 18 to 24. That's who we're going to serve, right? So you use data to start that out. You might say, oh my gosh, the population living in poverty is increasing, or the population living in poverty is worse in these areas, the darkest blue. You can see all this on CNY Vitals. Or your need may be specific to certain groups. You might say, you know what, there are equity gaps. And this is if in Onondaga County, if you would compare the incidence of some of these good and bad things this was done for Blacks and whites in Onondaga County. So the first one, life expectancy. Black residents in Onondaga County, their life expectancy is 93% of whites. So if it was 100%, they'd be equal, right? So it's less. Graduation rates is 76% of whites, right? So you can point out disparity, and you can do that with all of these things. So that's an example. Another way, infant mortality, right, is nowhere near 100%, which would be equal. So that's one way. So you start by saying this is the need in the community. Then comes into your logic model, which ties very much into your your resources. What are you going to need? Everything that you need in your audit, in your 990, all the things in your financial statements, that's really the stuff that these resources kind of sketches out. I need staff, I need housing. If you saw that presentation, you're like, oh yeah, we have lighting, and how do I build that, right? Is that a fixed cost? Is that is that a step cost? Whatever. Those resources are all going to be in your budget, but you kind of, you talk about them here, then you talk about what activities, right? This is where you kind of plan a program well before it kind of works its way into your books, right? When you're just thinking of a program, you figure out what activities or services am I going to provide? What are the outputs? How many people am I going to serve? And how are they going to like the service, right? If you go to a hotel, the outputs are how many people came, how many people showed up to the hotel, and 2, did you like the service? They give you a little survey. Did you like the pool? How was the service? That's an output, not an outcome. The outcome is whether you come back, right? It's the repeat service, right? And so you have short-term outcomes, and then long-term outcomes is going to be like, wow, this hotel is so popular. We're going to build more of them, and the impact. That's what people often start with. That's the ending homelessness. That's the ending poverty, and that's where you have to oftentimes use the literature to jump from the outcomes to the impact, right? So there's a chronology often to this, the short-term outcomes and long-term, something that happens first, that's your leading indicator, and something else that's a lagging indicator. You might, if you follow US data trends or the economy. You say, oh, the consumer spending is, is a leading indicator for, stock prices, right? And so you've got a leading indicator. If that goes up, this is probably going to go up later. That's a lagging indicator. So that's kind of what a short-term and long-term outcomes are. All right, so time for a quiz. All right, hopefully you paid attention there. Which of the following is not a component of a logic model? We just showed you a logic model. Granted, you didn't fill it out, but let's see if you can figure out which one of these is not part of it. Is the resources, activities, outputs, outcomes, impact, or is it time-bound? What is it? We're almost done, right? Okay. So after this, I think the rest is just going to be just pointing out. You can take a look at those slides. Those are just good places to get fantastic examples to dream about these things.
A question did come in too that I want to talk to you about.
Okay.
So we'll cover that quick.
Okay, and people got it right. The time bound is time bound is not part of it. The other parts were all part of a logic model.
All right, so I want to ask you this question that came in. It actually came in during Peggy and Angela's presentation, but I thought, with the Community Foundation, this might be a good question for you. So there's a lot of the time, grants are not covering enough of the admin salaries, and organizations are struggling on how to either fight for more dollars to help cover some of those costs, and they want to know how better to portray this to donors and funders to try to leverage some more of those dollars. Is there any suggestions you have to those small organizations that are really struggling to put on a program but also make sure all their wages are covered under those?
Yeah, I think it's a great, and I can see why that came in during the past presentation where, we're saying, how should we allocate it? 100% the program, because that's what donors want to see.
Yeah.
The idea is that, and that it could be an example of a poor PMI. Remember we said sometimes KPIs, key performance measures or indicators, can lead you in the wrong direction. If it is the lowest overhead possible, if people are mistaking that as an example that you're thinking initially, oh, that means more money going to the program, but actually you do need the staff to do the program, right? So it's misleading, and it could lead to not investing in your staff, high turnover, all sorts of things. And it's not the same as the outcome. So it's a good example of taking an output and kind of elevating that as an outcome and making decisions based on a key KPI that could be helpful, right? You don't want to have overly bloated. There were some places in the news that were spending too much on their executives, right? And we heard about those, and that led to, it's sort of like a pendulum, right? Shifting toward, oh my gosh, we got to reduce overhead. But now I think the pendulum's shifting back where we realize, you really do need staff to carry these out. And it makes a big difference whether your staff have been there for 4 months or 14 years. And the 14-year staff really do have institutional knowledge. And so making that case, again, it's always going to come down to the KPMI. What is that key measure? What is that thing that we can do better than anyone else and that we're doing? Here's the trend of how we're doing. Here is the, here's how we're measuring it. And here's what it costs. And so that really connects there. But you should not be ashamed to invest in your staff, to send them professional development. Definitely funders are seeing that more and more. We at the Community Foundation actually do have programs to send your staff to training, and have been pushing more and more for professional development, because investing in our staff, that is really the number one asset. And you want to make sure you don't miss out on that by trying to get the bottom line lower.
I knew you'd give a good answer for that. Thank you.
Thank you.
I think we missed one polling question, so
Okay.
I think there may be one more.
Here's one, because I was slow or fast. I know slow is the answer. So these are all just great ideas. Results First Clearinghouse, go there if you're looking for ways to measure. We're going to talk about more dashboards and what you like about them, what you don't like about them. These are local dashboards. Remember I mentioned there's one where you can actually say, to your legislator, this is how many people are enrolled in your program. This is a free system that's available in Syracuse area. These are something called results-based accountability, which also has a free tool. If you want to check out their website, they have a free tool, results scorecard. And here's an example of a logic model that has all those tools kind of put in there. And the question was here's the question. Which of the following is true? The more measurement is better. Stories don't matter, just the hard numbers and data, just the hard numbers data. It doesn't matter when you collect your data, things seldom change, and people need help putting your analysis into the broader context. So which of these is true? I think in the things that we covered, hopefully that's clear. I think I hit it pretty hard, but it was a while ago.
And we are going to provide all these slides to the audience, so they're going to be able to see all of those metrics that you've provided and all those really good slides. So
Yeah.
Fear not.
They are to really just help you dream. Now, if you're having trouble going to sleep, look at some of those metrics, print those out this weekend too, and just kind of look and say, and see if you can figure out what they are without explanation, and then see if they help you dream. All right, and you got it. Nice way to go out. So people need help putting your analysis into the broader context. They do. So data moves the head and stories move the heart. So just remember that, and hopefully that'll help you, and always happy to talk more. Thank you.
Well, thank you. That was amazing. We are going to take a quick, let's say like 10-minute break. We'll be back. What time, Jen? Is that 10:40? 10:40. We'll be back. So thanks again. Stay tuned. We've got a great presentation coming up from Shannon. Questions about your tax-exempt organizations. So stay tuned. See you in 10 minutes. Welcome back. I hope you've been enjoying the presentation so far. I know I have. As a reminder, you can continue to submit questions using the Q&A feature in the Conference.io app or in Zoom. Presenters' contact information will also be included in the materials shared following the conference if you'd like to follow up with them directly. Our next presentation, the top questions you want to ask your CPA about your tax-exempt organization, is presented by Shannon Forkin and Caitlin Mariano. Shannon is a tax partner and is the partner in charge of our Schenectady office. She has over 22 years of experience providing tax services, including multi-state taxation and strategic planning. She specializes in working with nonprofit, healthcare, and professional service organizations. Shannon earned her bachelor's degree from the State University of New York at Oswego and is a certified public accountant and chartered global management accountant. Joining Shannon today is Caitlin Mariano, a tax partner with the firm. Caitlin has more than 13 years of experience in taxation and tax planning for a variety of our clients, with a focus on contractors, manufacturers, multi-state taxation, and high net worth individuals. She has earned her bachelor's degree and MBA from Lemoyne College and is a certified public accountant. Caitlin also serves as the treasurer of County North Children's Center and I Got This, Inc. Please welcome Shannon and Caitlin.
Thank you, Charlotte.
you.
Hello, everyone. Caitlin, why don't you go ahead and start us off today?
Okay. So as Charlotte mentioned, what we're going to be covering is some of the top questions that you'll want to ask your CPA about your tax-exempt organization. And on this slide, we have an agenda of what we'll be covering today. So the first thing that we'll be covering is charitable contributions, substantiation, and disclosure requirements, in-kind contributions, quid pro quo, advertising and unrelated business income tax, private foundation minimum required distributions and tax on investment income, qualified charitable distributions, gifting appreciated stock, nonprofit student loan forgiveness, and then we've also included some resources for you. So first, I'll be covering charitable contribution substantiation and disclosure requirements. Some of the commonly asked questions that we see are, what documentation should we keep for donations? How do I ensure donor records are compliant? Is my organization responsible for providing donors with documentation for their donations? And is my organization responsible for determining the tax deductibility of a donor's donations? So regarding cash donations, we recommend that you keep a bank record such as a canceled check or a bank statement for proof of the donation. Written acknowledgement from the charity should include a few items, specifically the organization's name, the date, and the amount of the contribution. For larger donations, there might be some more detailed statements that are required to ensure that no goods or services were exchanged along with the cash.
And this is for the documentation for the people that are actually giving the money, because they're the ones that really have to prove when they're audited by, the IRS, or what they're reporting on their Form 1040, their individual tax return, okay, yes, this is the amount I reported and why, so.
Yeah, so this is what you would want to be giving to your donors. Regarding non-cash donations, we need to provide record of the description, its condition, and as well as the fair market value. For high valued items, an appraisal may be required. And it's important that the donees maintain these records of these items, so that way they can support the value and allow for the proper deductions when they claim it on their individual tax returns. When goods or services are supplied in exchange for a donation, that needs to be explicitly stated on the donor acknowledgement. The amount and the value of the goods or services must also be stated. The donor must be informed that only the amount exceeding the value of the goods or services is tax deductible. This is especially important for events where donors receive something for their donation. The main intent is to ensure that donors are fully informed and the proper amount of the donation is deducted. So in here, we have an example. We see this quite often where there might be a fundraiser, and with that, you receive a value for a t-shirt for signing up for an event. So for a donation of a $75 t-shirt is given to the donor. The t-shirt has a value of $20, therefore the amount that would be deductible and eligible to be claimed as a charitable deduction would be the difference, which is $55.
And on your point one on these, I get this question every so often. Who is required to, give the fair market value and things like that. And, if you think of the Salvation Army or the Goodwill receipts and things like that, they'll give you a blank statement saying that they received goods, but a lot of times the value's not on there. And it is up to the donor to substantiate that, I gave 3 bags of clothing, and, I value it at $100 or this and that. So ultimately it is on who's giving that donation. Except when you get into like some of those higher thresholds and things like that, there actually is, well, you'll get into it, so I won't get into it more, but.
And what Shannon pointed out, like organizations such as the Salvation Army and that, so if you do get those slips and you're trying to come up with a value, they do have on their website, a suggested range of values to use reasonably for what you would list as the fair market value for those donations. Again, the value of a non-cash donation will be determined will determine the documentation that it requires. Donations of property in the value of less than $5,000 must be listed on Form 8283. This form will list out the value, a description of the property, as well as its condition. And donations of property with the value over $5,000 require a qualified appraisal. The organization's disclosures to donors. They need to provide acknowledgement of donations of all kinds for the donor's records. Clearly inform the donors of the value of any goods or services received in return for contributions. Again, we're talking about that example we had with the t-shirt. So you would need to provide any type of value related to goods or services received. Specify the amount or portion of the donation that will be deductible. It's really important, again, to specifically identify the costs related to events or sponsorships. So some of the basic donor receipt requirements that need to be included are the name of the organization, a statement that the organization is recognized as a tax exempt by the IRS under 501c3, the name of the donor, the date of the donation, and the amount of the donation. The cash contribution and description of non-cash contributions also be included. On the slides, we provide an example that you can use or fill in the blank for modified as well as needed for your organization. This is a nice guide on how to give a letter to your to those who donate and kind of outline those things that we just noted that are required by the IRS as to what needs to be included as a receipt for those donations. Again, you need to maintain the proper documentation of donations from donors to remain in compliance. Structured documentation reinforces donor confidence, and maintaining these records helps strengthen the nonprofit's compliance and helps donors meet their tax obligations.
You know, sending these receipts too are a nice way for the organization to thank the people that have been giving you monies, you know, other services and things like that. So, you know, hopefully it encourages them to give more. So don't think of it as an additional task or anything like that, but more of, you know, kind of like a thank you and hopefully encouraging for them to give in the future as well.
And it's kind of like free marketing. So you get the opportunity to put your name in front of them again, remind them, oh, maybe they donated early on in the year, and getting that at the end of the year, they might remember, okay, well, I want to donate there again. So
Yeah.
it's a great reminder as well.
It's true. I've gotten receipts multiple times, you know, okay, once when I gave the donation and then like at the year and to just kind of summarize, you know, how giving you were. So
So donors can deduct a charitable contribution of up to $250 without written acknowledgement. Donations over $250 must have written acknowledgement for the deduction purposes. Non-cash contributions bring on more responsibility. The donor must maintain a record of description, condition, and fair market value of the items donated. Any goods or services related in exchange for the donation must be disclosed. And again, this information related to non-cash donations should be listed on Form 8283. So on the slides, we've provided an example or a copy of the Form 8283 that we've been referencing. Most commonly with individuals that we see, we usually fill out page 1. Not always do we have page 2 included. Page 1 kind of goes through, section A covers the property that's 5,000 or less. And again, there's the key areas that would need to be filled out, such as the description, the value, and the date of the contribution, the organization's information. Sorry, my eyes are a little tiny for me to read. Okay, so part 1, the second section, that would be for items that are over 5,000. And then on page 2, that's where it gets into when an appraisal is required. So anything that would need some significant substantiation. I've seen it sometimes where clients have donated a piece of art or a car. That value would need an appraisal to support what you're claiming as the value for your donation. So that's where we would get into the second page. And again, if there is an appraisal that is required, there's a signature section that needs to be completed as well. And we'll be going into our first polling question. So does your organization provide donors with donation acknowledgements? No. Yes, automatically for all donations. Yes, but only when requested.
and hopefully for well-established 501c3s. This was just old refreshers, items like that. But, you know, once in a while you get those questions, those oddball questions of, you know, what do I have to give for? What is there a threshold limit and things like that? But once you have your template set up, it's pretty straightforward.
All right, we're almost done. Hopefully you get your answers in. Well, it's good to see. Automatically for all donations, 74%. The next section I'll be covering is in-kind contributions and quid pro quo. In this area, some commonly asked questions that we see are, how are donations of goods or services properly reported? Does a receipt of goods, services impact the amount of the donation the donor can deduct? And are there goods or services that are not allowed to be exchanged? So by definition, an in-kind donation is another term to describe a non-cash donation. Examples include goods, services, or time. Quid pro quo in simple terms means something for something. So a quid pro quo donation is one that is partly of cash and partly for goods or services. The value of goods or services reduces the amount of the charitable donation deduction that can be claimed. A quid pro quo donation occurs when the donor receives goods or services in exchange for their contribution. Common examples include a t-shirt, a meal, or a few other items. The organization must disclose in a statement to the donor the specific value of the goods and services received. Note that only the amount of the contribution in excess of the value of goods or services received is tax deductible. These statements are very important so that the donor can be provided with accurate information and avoid overstatement of deductions. So for example, an individual makes a $100 donation and as a result of that donation, they're given a $40 event ticket. The tax deductible portion would be the $60 difference because they received a benefit of $40.
And I get the question as well as how do you value that event ticket, things like that. And I mean, there's obviously different ways, different things that go into it, but you pretty much know what your costs are gonna be. So one item might be, accumulating those costs, maybe the entertainment, the food, the event space, and then dividing it by, approximately how many people you've had there to kind of come up with a roundabout number. Might be one way, but obviously there's different ways depending on the event or depending on what the person is getting in return to determine that amount. So.
Yeah, it gets a little more complicated if you don't have, the option to just have those items separately sold. So then you need to come up with a better value. So it's a great way. Requirement of disclosure. Organizations are required to provide a disclosure statement of the value of goods and services exchanged for a donation. Quid pro quo donations of more than $75 must be disclosed in a statement to the donor to avoid penalties. The disclosure must inform the donor that the deductible portion of their contribution for federal tax purposes is the amount by which the donation exceeds the value of goods or services received. It's important to provide the donor with a good faith estimate of the fair market value of those items. So again, that's what we were just kind of discussing. So substantiating a value for the services or goods that they're receiving on top of with their donation. So according to the IRS, there are some instances where a disclosure statement is not required. If any of the following apply, a statement is not required. So if the goods and services are given have an insubstantial value, if there is no donative element involved. So an example that would be there's someone purchasing an item from a gift shop there is not a donative element when someone buys something from a museum gift shop. So you're obviously paying for that item that you purchased. There's no donation involved. There's only an intangible religious benefit provided to the donor. An example there would be where a donor is allowed entrance to a religious ceremony in which there's no admission charged, only an intangible religious benefit is provided. Or the donor makes a donation of $75 or less per year and only receives annual membership benefits. There is a penalty for failing to disclose. So charities that do not make these required disclosures of quid pro quo contributions that are valued at more than $75 are potentially subject to a penalty of $10 per donation. The maximum penalty is not to exceed $5,000 per fundraising or mailing event. And this penalty can be avoided if the proper disclosures are distributed or if the organization can show that the failure was due to reasonable cause. And now we'll go into our second polling question. What does the Latin phrase quid pro quo mean in simple terms? I don't know. Something for something, seize the day.
We didn't go over it. The real answer seems to be. Or if you don't know Latin.
Yeah.
2 seconds left here.
So we just want to acknowledge that there may be some technical difficulties with Conference IO today. If you have problems, please just send us a message privately in the chat and we'll make sure that if you need CPE credit, that we grant you CPE credit.
Right. So 92% of people are paying attention and got that one right.
And there was a question before we move on to the next topic that
Yeah.
came in.
Did you see that?
Yes. So does a library friends group that's a 501c3 also need to provide donation statement? So as Caitlin kind of went through, you know, individuals that are looking to take a donation on their individual returns are required to substantiate that donation of anything that's $250 or more. So it's good practice to, I mean, give them a donation statement anyways. I mean, you should definitely do it for the 250 and above, just so that they can substantiate their records. But then, like we had mentioned before, you know, I would just get into the practice. You have that statement. It's a nice thank you. It's nice advertising kind of for your organization as well. And then, you know, there's the other separate requirement for the quid pro quo. As Caitlin said, you know, does have penalties that can be attached for with it if you do not give that documentation. It's over the $75 limit.
So now we'll be getting into advertising and unrelated business income tax. Some of the commonly asked questions we see here. Do we owe tax if we sell ad space or sponsor an event? And what activities trigger unrelated business income tax? So advertising is how nonprofits improve their fundraising and outreach efforts, while advertising that promotes the organization's own programs or services generally are considered to support the organization's mission. Certain advertising activities can trigger tax consequences if they are unrelated to the organization's exempt purpose. So UBIT is triggered by income derived from a trade or business that is regularly carried out, but is not substantially related to the organization's mission. Mission-related advertising typically is not subject to UBIT. Promoting the organization's own programs, services, or initiatives are examples that would fall under this category. Unrelated advertising will typically trigger UBIT. This includes selling ad space in newsletters, websites, or event programs for commercial businesses that are unrelated to the nonprofit's mission. To ensure that your organization will not be subject to UBIT for advertising, make sure you keep accurate records of the purpose of all advertising activities. Distinguish between any mission-related and unrelated advertising. Report any unrelated activity and pay the applicable UBIT to avoid fines and penalties. Some common triggers for UBIT include any unrelated trade or business that's carried out by the organization. It's important that all activities carried out are related to the exempt purpose of the organization. If not, they may be put into a position where they have a tax liability despite their nonprofit status. Some additional examples of activities that can trigger UBIT include certain advertising, sales of goods or services to the general public, renting personal property, and public use of facilities.
This is one area that I probably get the most questions on, and they're very specific to the organization, because it, like most questions related to tax, like the answer always is it depends. So, you know, I urge you to reach out if you do have any circumstances that you think might be subject to the unrelated business income tax. So reach out to your accountant and ask them, oh, we're starting this new activity or doing this new thing. What do you think about this? Because it would depend on, you know, your mission, you know, what programs are you doing? What is your mission, first of all? And then how much of the activity you're doing, that can be a factor as well. And then, you know, it also depends on too, like, for example, if you're renting, like facility space, okay, is there a mortgage on that? There's just a lot of different factors and a lot of different items to look into. So, you know, to answer, you know, broadly individual circumstances is kind of difficult. And sometimes it requires more research and digging into what are you doing, how often, and things like that. So. But it can be very specific, you know, and what might be UBIT for one organization doesn't necessarily mean it's UBIT for another organization as well. So,
As with most tax law, it's always the answers, it depends. So
yeah.
if you're unsure, make sure you're talking to your accountants, your tax accountants, or reach out to us if you have a specific question. We're here for help when you need it.
And advertising is probably the main one that we see. And one of the areas too of advertising, they're saying, oh, well, the money comes to me, so it's for my mission. Okay, yes, well, anything you do, hopefully it's going to your organization to keep your mission, but it's more of the who are you advertising for? Like, are you advertising your organization's programs and services? Or is it someone from unrelated for-profit company is just advertising in your space or for your event, things like that. So ultimately, yes, we know like the money, you are collecting the money and it is going to ultimately go to your programs and services and things like that. But, it's more of who's advertising initially benefiting that's bringing in the money. So that's why we kind of hit on that one. But there's lots of different circumstances. So like I said, definitely reach out if you do start some kind of new activity or income stream and things like that. So, okay. All right. So if you haven't noticed, this year, our presentation, we weren't really going through like the 990 and exact circumstances and things like that, but more trying to hit on throughout the year, like what kind of things that we've been hearing, people are questioning us about, and things that kind of needed like more of an explanation on those hot topic areas. And also, I haven't hit on private foundations in I think quite a few years or anything related to them. So I do want to kind of go through a little bit of a 990 PF and the private foundation. Since we're not hitting on the regular 990s, I'll hit on the 990 private foundation just a little bit. And those two kind of main topic areas that we do get questions on, and how to calculate things and what should I be doing. So the first item is the minimum required distribution. So like I said, this relates to the private foundations, those organizations filing the Form 990 PF. And generally private foundations are required to actively support charitable purposes rather than indefinitely accumulating assets. So I'm speaking generally now. A lot of private foundations, they might have received a big amount, they hold an investment account from initial contribution to then help support other charitable organizations, 501c3s and things like that. Well, to kind of circumvent these private foundations from just having all this money that was donated into the private foundation, sitting in an investment account, growing and earning incomes and no tax ramifications or no way that they are kind of pushed to distribute these assets, they have two requirements, minimum required distribution and also excise tax on the investment income. So what is the minimum required distribution? So minimum required distribution is a certain percent of the asset value each year that must be distributed. Loosely said, we'll get into the calculation a little bit further when I have this page of the 990 PF come up, but it's about 5% of the average fair market value of the investment assets that must be distributed each year. And the monthly value is actually, we have spreadsheets that we do to kind of calculate this, because it's not just like the beginning of the year, the end of the year. What we basically take is the beginning of the month, end of the month, average it for the year. And we do that for their cash. We do that for their investment values, so on and so forth. Or, if they have multiple accounts, multiple cash accounts, multiple investment accounts, taking those averages to determine the 5%. And then also there's, we subtract out the investment tax and things like that. So, but on average, if you're trying to determine what is the amount that I should have to distribute, it's about 5% of those assets. And if you can have the calculation a year ahead of time, meaning, so for this upcoming year, the 2026, saying the private foundation's on a calendar year, the 2026 minimum required distribution that should be made by 12/31 should already be determined. When you filed your 2025 Form 990 PF, which including extensions, the latest due date would be November 15th of 2025. it would have that amount that would be required to be calculated. And that gives you, you know, a full year of you knowing, you know, okay, oh yes, I know, or almost a full year you would have had, because you have up to November 15th to like true it up and things like that. You know, if they're required distribution. So you do have some time. You do know what that amount is before the end of the year. So what are qualified distributions? So there are a few things, and this is also a misconception as well. If they think some people think that qualified distributions are just the amounts that you give to other charitable organizations. That obviously does count towards it, and that is probably the biggest chunk of the qualified distribution for these private foundations. But it also can consist of a few different things. And you'll see later on a slide as well, where we kind of go through the allocation of some of these expenses to what can be considered expense that can count towards the qualified distribution, expenses that can count towards your investments. So as for qualified distribution, in addition to your grants for public charities, you also have some administrative expenses that can go into grant making. Anything that has to do with charitable programs or other assets and expenses associated with the foundation's exempt activities. And as I noted before, expenses related to investment management do not count, and you'll see this further on, kind of how you do this allocation or determine which ones are qualified distributions and which ones are expenses for investments. So you're never going to get it dollar for dollar unless you're like tracking daily and very thorough. So any excess distributions can be carried forward 5 years. So when we give the amount, you know, okay, this organization has to distribute $846,511. You know, we always say, just in case some of these allocated expenses and things like that might be a little bit less than you're predicting for the year when the year end actually ends, you know, maybe give a little bit more, give $850,000 just to make sure you're covering the excess and things like that. And you're not losing anything. You'll see on upcoming page of the Form 990 PF how that amount carries forward for the 5 years and things like that. And that excess actually goes into the calculation to determine the next year's qualified distributions. Like I said, you kind of don't want the shortage, because there is a possibility that you would be subject to a 30% excise tax for each year that you don't make this qualified distributions, with any penalty and things like that. There are ways to get around it, especially if it's not willful neglect and if you make up the difference as soon as you are aware of it. But you probably don't want to get in that circumstance to begin with, because you have to file a Form 4720 and it's just extra additional steps. But so just make sure, once by November 15th of that year, that required distribution amount, you're distributing either that amount or more. And then as far as penalties as well, if you know about the shortage, you receive notice, you still fail to rectify that, which I don't know any organization that would or fall into this, but there isn't a 100% tax or penalty. So that's the minimum required distribution. And then next we have the tax on investment income. So this is the other piece that you have to be aware of. Private foundations, and you think, oh, we're a not-for-profit, we don't owe anything, but you would. So if you have your investment account and it is generating interest, dividends, capital gains, those type of things, that would be subject to a tax rate. Way back, well, I say way back when, but before 2019, it used to be a 1% or a 2% rate based on other factors and things like that. But as of December 20th, 2019, it is now a flat 1.39% rate, which makes it easy to calculate for most of us, that you're taxed on this investment income. So it's actually the investment income less expenses allocated to it. And we'll kind of go on to that. But first, let's do a polling question. So what percent of fair market value of assets is a private foundation required to distribute? And this kind of relates to my previous discussion on the minimum required distribution. So is it 5%, 10%, or 15%? Hope you're listening, even if you don't really deal with private foundations too much.
Few seconds left to get those answers in.
Okay. Oh, got about half of you listening. So it is 5%. Like I said, that was a loose calculation. But distributing more, I mean, 10%, 15%, you're doing good. You know, distributing more is not a bad thing. So. Oh, I don't know why. My slide didn't get in there. PF example. Okay. Well, my Form 990 PF that I had, oh, it didn't get in there. But anyways, so when you're doing a Form 990 PF, starting with like part 9 of the form is where you would calculate the minimum investment return. The next section is the distributable amount. Section 11 is the qualifying distributions. And all these sections feed into the part 12 of the Form 990 PF. That basically calculates, here's the current year's required minimum distribution, less what was actually distributed, any carryovers to determine your net amount. So just kind of looking at those sections, Form 990 APF, like the Form 990 is pretty voluminous and a lot of pages, but starting with those section 9, the Form 990 PF, you get into that. Okay, so kind of going on a different page. So excise tax on investment income, as I had stated, with the private foundations, I kind of didn't finish my thought on that, but just be aware of that there is an allocation between the investment expenses and related to that, and then the private foundations related to the qualified charitable or required minimum distribution for charitable organizations. So that'll end the private foundations. And now what we wanted to kind of get into is some of these questions that we have on all of our tax-exempt or charitable organizations that are looking to kind of motivate their donors on how they can give better, or actually encourage others to give more. So the first kind of tool that we say, should kind of push, make your donors aware of, especially those higher earner taxpayers, or the more of the, not the elderly, but I don't want to use age 70 and a half, those middle age people, as a qualified charitable distribution. So each year, if a person has an IRA, they are required to do a distribution, and it's based on the value of their IRAs, and most of the time their broker will determine that value for them. This amount from a regular IRA is taxable to them. However, if a portion of that is given as a qualified charitable distribution, they can escape bringing that income onto their tax return, and instead, save on that taxable income. So that is one tool. As I said, the eligible distribution must be for 70 and a half or older, must be transferred directly from the custodian to the qualified charity. So a lot of times we just have you contact your financial advisor, the brokerage account that you work for, and they will facilitate this for you. Kind of one item I will say is that you don't we still get the regular form 1099-R at the end of the year, and it'll report the full amount of your required minimum distribution. So you still have to let your tax preparer know what amount of that went towards a qualified charitable distribution or was given to the charity, so that they know to reduce your taxable income that way. And just to kind of let you know too, it's not include, because this is reducing your taxable income, you can't double dip on it. So it's not going to be an itemized deduction as well. So it's either or. There are certain contributions that do not qualify as a qualified charitable distribution. And these are amounts that are given into a donor advised fund, private foundations. And I will say that there's a couple different categories of private foundations, operating and non-operating. So specifically here, when we're speaking of private foundations, giving to a non-operating foundation does not qualify, but an operating foundation would. And then the limit changes each year based on inflation, things like that. So say your required minimum distribution from your IRA is a couple $100,000, you can't just give that whole amount to a charity and not take that into taxable income. It is limited, and for 2026, this amount is $111,000. Like we said, you should document this, because that 1099-R that you get at the end of the year isn't going to state the amount that was given as the qualified charitable distribution. So if you can have, some kind of reporting statement, like I said, if you're doing it through a financial advisor or brokerage account or things like that, they can show the money going directly to that charity for you, or a receipt from the charity that they received it is always good as well. But just make sure you're passing that along. Next is gifting appreciated stock. Maybe. Okay. So this is another avenue that could help you with encouraging people to donate. So especially towards the end of the year, which now we're past the end of the year, but keep this in mind for upcoming, when people are meeting with their financial advisors, going over their accounts, things like that, they might be trying to clean up their portfolio or what they're invested in. And they might have some stocks that they've held on to for a while, and they want to re-diversify their accounts and things like that. There might be some stocks that they held for many, many years, or great stocks, maybe invested in Amazon back in 97 and you still have that, and you're looking to, maybe get something else besides Amazon, but you don't want to take in these huge capital gains. Gifting that actual stock to a charitable organization is a great way for the donor to avoid the capital gains that they would have to pay on. So they're still giving you the same amount of value. The charitable organization would be, responsible for doing what they would with the stock. Maybe they want to hold on to it too, or if they need that cash right then they can sell it. So just make sure that the donors aren't selling the stock before giving it to you, because then that kind of defeats the purpose of it. But actually gifting that appreciated stock is definitely a good avenue. And like I said, the donation should be directly to the charity from the donor to avoid the capital gains tax. And this increases the donor's giving power. They're saving that 15-20%, depending on what tax bracket they're in, of tax that they would normally have to pay on that capital gains tax. And then, maybe it'll be increased donation that they would be willing to give to the charitable organization.
I've seen that on a few of our clients where they'll gift it if they have very low basis and they're trying to avoid that huge built up gain. And they'll make a donation, and usually the advisor gives us documentation to support that.
Yeah, because the form that you went over before as well, you have to list out like the number of shares, the value of the date, and things like that, just to substantiate it too, especially if it's over that 5,000. That's And we kind of went over this, where the stock must be transferred directly to the not-for-profit and then before being sold. and you should have guidelines set up internally on how you receive, process, liquidate these securities. Maybe you already have an investment account set up to kind of handle these and for easy transfer in of these amounts. And then also definitely retain some written acknowledgement. Like I said, the tax preparers will be asking for that to report at the end of the year on that form 8283. All right, so who does gifting the appreciated stock benefit? Well, benefits the donor as long as they can donate it. And also the charities will maximize their benefits as well. And it also benefits the organization. They have some flexibility too, like I had mentioned before, whether they want to keep that asset, maybe it'll grow even further, or if they need the cash now for some program or service, support their mission. So I kind of just gave my question away, but so whole question, if you're listening, perk up. Who does a gift of appreciated stock benefit? No one, the donor, or the organization and the donor? Few more seconds here to get your poll questions answered and in. Okay. All right. Sounds like everyone's listening, or they just knew the answer to begin with, so.
We'll go with their list.
Yes. All right. So I've hit on private foundations. We hit on hopefully a couple tools for you to encourage those donors. And then another topic area that we've, been seeing people asking questions about is, staffing is an issue as well, and keeping employees and motivating them. And, you deal with competitive salaries and for-profit organizations, things like that. So what can we do, especially on limited budgets and things like that? So there's a student loan forgiveness. It's actually called the Public Service Loan Forgiveness. And my title is probably a little bit misleading because it's not just for not-for-profits. It's actually it's a program for government and not-for-profit to be able to get some student loan forgiveness they may have. So once a person has made 120 qualifying monthly payments under acceptable plan while working full-time for an eligible employer, they may be subject to some forgiveness. And we'll get into some of the details of this on a few of these additional slides. So there is an application involved, and in the resources at the end, we have the website there that if you think anybody might be eligible for this or looking for this to kind of go. And there's a tool to assist in completing the application as well. So first off, it has to check if the employer is already in the database. If it's not, and you think the employer is eligible for it, there will be steps to be able to, get that eligibility in there. And then obviously there's things that you have to sign and, request certification. The employer or the tax-exempt organization has to sign off on this as well. So how do you know if a employee or person will qualify for this forgiveness? So they must be employed by U.S. federal, state, local government, or a not-for-profit. They must work full-time for the agency or organization, which we'll go over what qualifies as full-time. And then they must have a direct loan. And there's consolidation that can occur and things like that. So they definitely have to make sure the types of loans that they're paying off and things like that are considered a direct loan that would qualify for this. And there's different plans, repayment plans under this, but in short, they have to have made 125 qualifying payments which is typically, a 10-year period. And they don't have to be consecutive. Like I said, it's generally 10 years because you generally make one payment a year, but overall it's 120 payments. And so as far as employment, it's the employer that it matters. So since you're a not-for-profit, a 501c3, they're working for you. That's qualification enough. It doesn't matter if they're not doing the actual, charitable activity of organizing and running the programs. They might be your accounting person that's sitting there, but because they work for you, they would be, eligible. And full-time employment is actually considered 30 hours. So if you're thinking it's the 40-hour criteria, it's actually a little bit less than that. And it has to be during the period that's being certified. So that's 120 consecutive payments or about 10 years that they're looking at the period for this loan forgiveness is when they should be full-time or 30 hours. And a couple little caveats there as well. If there was a break in service, for leave taken under the Family Medical Leave Act, so that can be included in there. However, volunteer work is not included. So you definitely have to be an employee, not just a volunteer. These are the types of eligible loans. Like I said, make sure you're looking at this first to make sure it is a eligible loan that was being paid. And the qualifying payment is a monthly payment made while employed full-time by the qualifying employer while under the qualified repayment plan. So can't be paid 5 years, then you worked for the not-for-profit for another 5 years. No, it has to be 10 years while you're employed. And these are the income-driven repayment plans. There's a few of them. Income-based repayment, income contingent, pay as you leave, and saving on a valuable education. So that concludes our presentation today. And as I stated, we did have some resources that we always provide you with, and you'll find these in the back of the presentation as well. Any questions? It was kind of a quiet group today.
That's because you did such a good job explaining it all. All right, thanks, ladies. And again, if you have any questions, their contact information will be provided at the end of this, and you can reach out to them directly. All right, so as we go on to our final presentation, I'd like to note that there will be an evaluation at the end, which will be in Conference IO. Some of you, we've been troubleshooting the Conference IO app. If you want to open up a separate browser, that seems to be helping, or if you answer the polling questions from your phone. So please feel free to do that. Our final presentation, I am pleased to welcome Peggy Rowe, who is stepping in for our Accounting and Advisory Services Director, Christine Petrone, who unfortunately was unable to join us today. Peggy's going to be presenting Audit Survival Guide from Panic to Prepared alongside with Taylor Green, one of our audit seniors from the firm. Taylor has more than 5 years of experience providing audit review and compilation and consulting services, particularly in the nonprofit sector. She has her associate's degree from Cayuga Community College, her bachelor's degree from Lemoyne College, and her MBA from the State University of New York at Oswego. Taylor currently serves as the Vice President of the Syracuse Chapter of Accounting and Finance Women's Alliance. She is also a member of the Order of Eastern Star and an adult advisor of the International Order of Rainbow for Girls. Please join me in welcoming Peggy and Taylor. Good luck.
Thank you, Charlotte.
I think in your 24 years, you've never presented twice, though.
I don't think so. I think I need double credit this
Yeah,
year.
you will.
So rather than 24 years, it's been 26.
So as Charlotte said, I'm Taylor Green, Audit Senior here at Dannible.
with Peggy, who's obviously already been presented once today.
Yeah, I mean, we're gonna, some of the, Christine and Taylor did write the presentation. And we chose to talk about audit survival. We're gonna talk about some different things as far as like best practices and pitfalls and, really kind of go through, with Christine being in the our accounting department for our clients. We have a lot of nonprofits that we do the accounting work for. So we are also usually typically involved significantly with the other audit firms to do the audits with them. So they have a unique perspective on what the best practices are to get ready for audits and kind of how we do that for our clients when we're on the other side of it.
So today we're going to talk about something that really everyone here has felt at some point, the audit panic. When you receive that initial notification email, your stomach drops a little, employees start asking questions, suddenly everything feels urgent, and files you know existed for sure, you suddenly can't find. So everything is suddenly rushed and very important, and there's not enough time to get anything organized. Today's session is designed to change that experience as a whole. By the end of our time together, I want you to feel more confident, more prepared, and more control of your audit process. We're going to walk through the most common pitfalls organizations run into, the key to communicating with auditors, a practical step-by-step approach to moving from panic to prepared, and finally, what you can and should be doing year-round to prepare for the audit. So we're going to start with a first poll with, has your organization been through an audit before? Really simple. Oh.
Here we go. All right. Technical difficulty.
Technical difficulty.
We're gonna chalk that up as technical difficulties today.
All right. So
What's the right answer?
there is no right answer. Yes, no, or maybe you haven't done a full-scale audit. Maybe you've only done a financial statement review, which is a lower level of assurance and a little less testing than a full-blown audit. But there is no polling question popping up, so no need to put a question into our moderators. So we'll go right into the presentation then. So why do audits feel overwhelming? Audits tend to trigger a panic response for a few very specific reasons. One, they come with deadlines that feel non-negotiable. Auditors have timelines to get things done. Boards are expecting reports. And those deadlines don't pause your day-to-day responsibilities on top of all of that.
And it may not be just the deadlines of, the organization, but obviously we have deadlines for granting organizations. If you're having a compliance audit with the federal government, getting all the information ready so that the 990s or 990 PFs can be done. So there's a lot of different deadlines there.
Banks, if you need to get statements to banks. Second, audit requests can feel unpredictable. Many requests are actually very similar year over year, but they often arrive all at once, so everything feels very urgent. And third, this is a big one, there's often an emotional component to audits. People worry about being judged and they worry about missing a document or an error that's going to reflect personally on them. But many people feel like audits are a test that they can fail, and that mindset alone creates anxiety. So let's reframe the narrative. Audits aren't about catching people making mistakes. We're not evaluating you as a professional. They're evaluating whether documentation supports what's in the financial statements. We expect questions, we expect follow-ups, and we expect to find opportunities for improvements. So when you reframe the audit as a structured review rather than a test, it becomes far less intimidating. So now that we know why audits are very overwhelming, let's dig into some of the most common pitfalls that we see again and again. So this section is intentionally focused on what could go wrong, not necessarily how to fix them, but we'll get to the solutions and avoiding them in the next section, the next little piece later on in our panic to prepared section. So the most common audit issue is disorganized documentation. Support may exist, but it's scattered across shared drives, email threads, desktops, or even paper files, and no one is quite sure which is the final version. When documentation isn't organized consistently year-round, the audit prep turns into a scavenger hunt. This creates stress not just because of the documentation is wrong, but it takes time to locate and confirm that it exists. Auditors value clarity and traceability, being able to quickly see how a number ties back to support. We aren't just checking the numbers, we're also verifying the evidence exists. From an auditor's perspective, missing documentation, it isn't just inconvenient, it increases risks and can lead to more questions and probably more testing as well. So more support that needs to be gathered. Another common problem is there's no clear ownership over documentation. Everyone assumes that it's someone else's responsibility for maintaining it. When that happens, requests take longer to fulfill, staff scramble to piece together information, and the audit immediately feels stressful. Internal controls are another major area where organizations struggle. Sometimes controls don't exist at all. Other times they exist on paper and they're not actually being put into practice and operating the way they were designed to. We often see controls that worked well years ago, but no longer make sense because the size of the organization has changed or the structure of the organization has changed. In some cases, there's a heavy reliance on manual controls, which increases the risk of human error. For example, manually entering bank transactions rather than linking a bank account and having those transactions flowing automatically into your accounting system so that all of your records, you're making sure everything is included. Segregation of duties is also a frequent challenge, especially in smaller organizations. When one person is responsible for receiving the funds, recording the transactions, reconciling accounts, and even making deposits, it creates a significant control gap. Even if there's complete trust in that individual, auditors still have to assess the risks. A written policy that isn't followed consistently is just as concerning as having no policy at all. Data and systems issues are another common pitfall, particularly when organizations rely heavily on spreadsheets that are outside of their core accounting system. Spreadsheets can be useful tools, and we're not trying to dissuade you from using them. However, problems may arise when multiple people can access them and update them, and version control is weak. You don't know which is the correct version that should be updated, and that changes themselves aren't documented. So you don't know if the change being made, why it was made, and if it's correct. In those cases, it becomes difficult to determine which data is accurate. Weak access controls or shared logins also raise concerns. Auditors were looking for clear audit trails. We want to know who made the change, when they made the change, and why they made the change. When systems don't provide that level of transparency, auditors have less confidence in the data, which again leads to expanding testing and more scrutiny on your records overall. Staff and training issues also play a big role in audit challenges. Many staff members simply aren't aware of audit requirements or don't fully understand organizational policies. New employees may inherit a process without any documentation explaining why things are done a certain way. They might not understand why you need to write on your invoice what program this expense relates to. High staff turnover only makes this worse, especially when key processes depend on one individual for them to occur. We often hear statements like, that person used to handle this, or, oh, I didn't know we were supposed to keep that. From an audit perspective, lack of awareness leads to inconsistent answers, delayed responses, and gaps in documentation. And all of this adds time, frustration, and risk to the audit process. So risk and compliance management is another area where organizations tend to be reactive rather than proactive. Risks are always identified, aren't always identified or reassessed regularly, and regulatory changes may go unnoticed until an audit brings it to your attention. Previous audit findings are sometimes ignored and or addressed only temporarily, which leads to repeat findings year after year. Auditors expect to see progress. When the same issue appears multiple times, it signals weak oversight and a lack of accountability. Even small improvements can make a difference, but ignoring findings altogether almost guarantees continued problems. When we're reporting findings during our audits, we're not doing it as we need to say something. We're giving you recommendations that we think will improve your organization. Probably a good idea to put those findings, to fix those findings, correct them.
Right, we're looking for, right, we want to, kind of as Angela said, you know, when there's less issues in the organization, that's the organization you really want to audit. Like, we want to work with you guys to make sure that the issues that we're finding is you're starting to slowly improve on those things, and really kind of take that seriously. So, you know, maybe in a few years you could have an audit that doesn't have any comments because you've made such improvements that, you know, there is no comments to make.
Follow-up and remediation is closely tied to this. Many organizations struggle with implementing corrective action plans in a meaningful way. Sometimes fixes are delayed, sometimes responsibility isn't clearly assigned, and other times changes are made, but they're never monitored to ensure that they're actually working as intended. Saying something is fixed isn't enough. Auditors look for evidence that corrective actions were implemented, documented, and sustained over time. When that doesn't happen, repeat findings become almost inevitable. Governance and oversight also play a significant role in how audits unfold. Limited management or board involvement can create gaps in accountability. When roles and responsibilities aren't clearly defined, important issues can fall through the cracks. Auditors assess not only the numbers, but also the tone at the top. Boards and leadership are expected to be engaged, ask questions, and understand the organization's financial and compliance risks. At the end of an audit, often, not always, the auditors will present the financial statements and the findings to the board. The board should be paying attention during these. There's often not a ton of questions being asked, which kind of shows that the board isn't as involved or understanding of what's going on with the organization. Asking questions shows the auditors that you truly care that the financial aspect is working just as well as just the programmatic aspect of the organization.
Right, when we're presenting, you know, I've always done my audit presentations to boards with the insight that I want to make sure that the board understands the financial statements. So my presentations have always been not necessarily talking about our board report and the auditor's responsibilities and management's responsibilities specifically, but I usually spend quite a bit of time on the actual financial statements to explain the theory and like the importance of different things so that not only management can learn, but the board of directors, right? The board of directors is made up of a lot of different people who may not be accountants, who may be attorneys or different areas that, they don't necessarily understand the financial statements for nonprofit organizations. So again, that's what we try to do.
Hopefully many, if not all of you, were at our nonprofit conference last year where we actually discussed the different roles and responsibilities for the board versus management. So hopefully you guys are all professionals, experts on what those different roles are.
Right, and just think about too, you talked about the segregation of duties, right? If you are a, I think we talked about this last year, right? This is wonderful. If you are a nonprofit organization that is smaller in staff and you have a board, that board may not be just completely oversight board, but they may have to take a little bit more involvement in the organization, like segregation of duties. What if you have one accounting person? You may have to have like the treasurer who is reviewing the bank statements before they come in, or just doing a little bit more so that the people that are on staff know that there's oversight, and that's a really great internal control to help with segregation of duties.
So preparation and readiness is another major pitfall. Many organizations aren't clear on the scope of the audit or what documentation will be needed or when requests will be due. So this uncertainty leads to last minute scrambling, rushed responses, and increased stress for staff. When records aren't prepared in advance, mistakes are more likely and the audit feels chaotic rather than manageable.
I'll tell you one story. I've told the story to my staff before. When I was a staff person, I've had people say to me, if you look organized, if everything you give me is neat, then it makes it look like you appear that you know what you're doing, whether you do or not. And I think that perspective too, like when we talk about like as a staff person with the partners, it's just kind of the same thing. It's a little bit of the same thing with a audit team, right? We go in there and everything's really organized and you're answering our questions right away. You know the answers, all of that stuff. It gives us a positive feeling that you guys know what you're doing. And that, when we start getting fed information that isn't organized and consistent, then we start asking more questions.
I'm a lot more skeptical of what we're being told.
Yes.
So communication and organizational culture, one of the last pitfalls we're mentioning today. This can either ease the audit process or make it significantly more difficult. Defensive attitudes, inconsistent responses, and fear of admitting that you're wrong or mistakes have been made all create tension. Auditors aren't there to catch people doing something wrong. They're there to assess the risk and verify information. When staff are afraid to speak up or feel judged, transparency suffers. Poor tone at the top can reinforce this fear. And if leadership discourages open communication or treats audits as adversarial, that attitude often filters down through the organization. On the other hand, clear, honest communication tends to lead to smoother audits and fewer issues overall.
You guys ready for a question, a live question?
Oh yeah, so exciting.
One of our attendees has a question. I'm going to open it up. Brenda, go ahead and ask your question.
Uh-oh.
Did you have a question?
I'm sorry. Earlier I had a question regarding sponsorship, but I think it was in the other session.
Okay.
About how we I don't remember. You caught me off guard. But it was basically about when they were talking about the different donations, or I think it was quid pro quo or something like that, where if they gave an example of $75 donation, 20 of that was for the t-shirt and 55 of it was tax deductible. But I was concerned about, we do a big event, community outreach day, and we request sponsorships. Some people purchase tables, or some sponsorship levels, they get a logo in our. Um, we've never been audited. I'll say that because we're very small and we've been 990 postcard, but we're getting a little bit better. But just trying to get a grasp of all this. So yeah, that was kind of jumbled up. But if there's anything in there you can respond to, I'd appreciate it.
So luckily, we still have our tax experts in the room. Any commentary?
They're discussing the question to.
Yes, so if you're were you getting advertising or were you getting contributions and they're getting something in return?
So, for example, depending on what level they did sponsorship, they might they would have a table at our community outreach day if they chose. They would be listed as a sponsor. They would
So say they're
something on their website or whatever. Just
yeah, so say they're getting like a few, like with their sponsorship, they're getting 4 seats or 4 tables, then you would put in your donation receipt what the value of those like 4 tickets would be.
okay. So right. So the information table that they'd have out so that they can meet the community members. Because it's like an outdoor fair sort of thing. So what other people are paying to have a table at the event, they would, yeah, I don't know.
So if they're just getting a table, they're not really getting anything in return. It's more of if they're getting like a meal or something that the organization had to pay expense for. But if they're just paying amount to have a table set up, then it's not really quid pro quo.
Are there other people paying for like these tables to be set up without a donation? Like if there's like a price to have a booth.
Right. So okay. So if it was $50 just for a table, but say for example, like we have these different levels, like a community visionary, this, that, or the other, and they may receive a table. They may have time to speak to the audience. They may have a logo on our website or in the program booklet, or some of these little perks that come with um, the level of their donation.
Yeah, that's not really the quid pro quo. I mean, I would probably give them a receipt for the value that they contributed, but they're not technically getting anything like physical back in
Mhm.
response.
Okay.
So
It just helps us put the event on, and it
right.
teaches a lot of people. We do it during National CPR and AED Awareness Week, so they're learning about hands-only CPR. They're meeting community organizations, whether it's the land bank or poison control or the emergency management fire department. It's just community outreach day.
Right.
Good. Well, thanks for raising your hand. Hopefully that helped answer that.
All right, thank you.
Thank you. All right, ladies.
So we're gonna go into our second poll question, the first one that's popped up. What pitfall does your organization experience the most? Is it disorganized documentation? Everything is scattered around the organization. You're not sure where it is actually being held. Lack of internal controls. Maybe you don't have a set process in place, or you have one and no one's actually following it. Last minute scrambling. You guys aren't getting prepared ahead of time and gathering that information in advance. Or lack of oversight. The board isn't involved in asking questions. A few seconds left. Last minute scrambling seems to be the biggest answer, and disorganized documentation. And luckily for all of you, we do talk about that in this next piece that Peggy will be leading.
So we're going to talk from panic to prepare, best practices for audit preparation. And again, it's what I said before. We do this for a lot of nonprofit organizations. to, go through and do the preparation in conjunction with the on-site accounting people or the executive director. So we'll go through some of this, and Taylor will give her
I'll chime in.
when as the auditor.
Yes.
Okay, so at the end of the year, closing of the fiscal year, just keep in mind, so we're talking about closing of the fiscal year, but where I really want to like concentrate on is that it shouldn't be a panic, because a lot of these things you are doing all year long. You're closing all of this stuff, so you don't need to panic. It's just a matter of doing like the final close. I know that some organizations do, you keep the bank recs up, maybe the investment accounts. Sometimes you may be keeping some things, tracking more on a cash basis during the year, because you don't necessarily need to do such a hard close on the accrual basis at the end of the year. But when we go to the end of the year and prep for audit, then we have to make sure, if you are on an accrual basis, which most organizations need to be at this point, with the change in the New York State wanting everything to be on accrual basis when it comes to filing the Chart 500. So just looking at the list, we listed some different things like the bank accounts. Obviously, we need to reconcile those at the end of the year, to make sure everything is accountable, everything reconciles. We are preparing those bank reconciliations. Hopefully, if you're using QuickBooks, the bank recs are in there. Going through, and this is one of the things that we do. We go through and actually look at the bank reconciliation. Just because it reconciles doesn't mean all of those reconciling items are appropriate. So you need to actually, look at the outstanding checks, look at the deposits in transit, look at the other things that show up in QuickBooks in that listing, and question, do those make sense that they should still be an outstanding item? If not, you need to look into those to get those cleared up. Petty cash accounts. Again, something that, we don't typically spend a lot of time in unless there was some issue as an audit, but making sure that reconciles, and you have the vouchers that all of the invoices or the receipts from the petty cash disbursements available in case they do get selected. The investment accounts, going through those, not only for audit purposes, you're reconciling to the investment statements, but for purposes of the audit, you not only need the balance sheet to agree, but you need to do the roll forward of the investments from beginning of the year to the end of the year to do a recap of your dividends, your interest, your unrealized gains and losses, your realized gains and losses, all of that stuff, to reconcile all of that, to make sure it agrees to the profit and loss section. And then one of the key areas for the audit is having that roll forward available, because on your statement of cash flows, we are required to show investment purchases and sales. So that's something that we would look at the client to do and make sure that that rolls forward, so we have the proper information to do that disclosure. The prepaid insurance, again, looking at that, I know that probably a lot of you do things on the cash basis when it comes to this during the year, but just going through and making sure that the expenses, if you've prepaid the insurance, making sure the expenses are in the right time periods, and taking a look at that, and pulling the statements and the insurance statements that we would need to do some testing on that. Prepaid expenses, there could be a variety of different other prepaid expenses. Anything you can think of off the top of your head, Taylor?
Tech, like if you have a tech contract, IT contracts, sometimes it could be like a 2 or 3 year IT contract. You may prepay that for all 3 years.
Yep. You prepaid that. So, just going through, and it's not, a lot of times people like kind of roll forward the same things over again, but you really should take a look at your general ledger and looking at it and seeing what could be prepaid to bring that up onto the balance sheet. The accounts receivable or grants receivable. Again, making sure all of that like works. We talked a little bit about the classifications and the categories in QuickBooks and making sure like if you have grants receivables, that all of that reconciles when it comes to the, a lot of grants are cost reimbursement grants. So you have to have your revenues equal your expenses, your net income on that particular column would be zero, but making sure you have the right receivables recorded based upon whether you've earned that revenue or not. Fixed assets is another item that accounting firms, audit firms usually provides assistance in. So just, making sure you understand who's responsible for that. If it's, if you guys are just keeping it on an Excel spreadsheet to keep that up to date. If you are not, and again, maybe you're doing that on a cash basis, but to, have somebody responsible for looking at the repairs and maintenance accounts, knowing what potentially will be having to be capitalized at the end of the year, providing those invoices to the auditors. Sometimes we do non-attest services where we're preparing the subledger for the fixed assets, so providing that to us, even providing it to us before we start the audit, so we can get that updated for you. And you get those adjustments made before the audit or before we're given the trial balance. The credit card accounts. Again, so if you have credit cards, making sure that you're getting a proper cutoff of those. A lot of statements are not at month end. They kind of go in the middle of the month, so you have to go through those, looking at the actual dates of the transactions to make sure those are getting recorded in the right period. The accounts payable, again, going through that, making sure, as part of our audit, we go through and do a cutoff for accounts payable, looking at, the invoices and the checks that have gone out after year end. That's really something that you guys should be doing when we're preparing for the audit, is to take a look and making sure that we're getting proper cutoff, especially at year end. There's items for accrued payroll. You may have a payroll that gets paid in, if we're 12/31, gets paid in January, but a lot of the days are for December, so we have to make sure we get proper accrued payroll done. We have to do the accrual for that. We have to do the taxes, and we have to do, one of the things we see our clients not doing is the employer's portion of FICA and their taxes. That's another part of the accrual. Accrued vacation, we may have like PTO that needs to be accrued. If you have loans, a mortgage, making sure you're getting the appropriate statements at the end of the year. If you have amortization schedules, making sure that's all available so that we can reconcile that. If you have a line of credit, making sure that you're getting the line of credit statement that shows the ending balance. Sometimes I've seen bank statements that don't give you enough information, and the client needs to reach out to the bank to get some of that information. Deferred revenue is another area. It really kind of is related to the grants or accounts receivable going through, and if you have a cost reimbursement grant and you have received monies on it up front, but have not incurred the costs associated with that, you may have to record that as a deferred revenue, as a liability back to the granting organization until you have earned that revenue and have the qualified expenses.
It doesn't really say on here, but also your net assets, tracking with and without donor restrictions is a big thing. A lot of smaller organizations tend not to track that. And it leaves the auditors kind of having to comb through your revenue for the year to see if maybe there's any restrictions on those funds. And then having to ask the question, following up, causing more delays in the audit of, this money was restricted for this purpose. Did you spend it how it should have been? Or should it be included in your net assets with donor restrictions on your financial statements? That's kind of one of those recommended, maybe keeping a spreadsheet that, with restrictions on who and how it can be updated, but tracking that separately so you know what all restricted revenue you've received and how those funds have been spent as of the end of your fiscal year.
A few years ago, the FASB in their wisdom changed the net assets for nonprofits from being unrestricted, temporarily restricted, and permanently restricted. And they chose to show on the face of the financial statements that it's with donor restrictions and without donor restrictions. And I remember getting a lot of questions from clients and going, oh, great, now we don't have to track that. We don't have to track any of that. And that's not necessarily the case. So you still have to track all of that. You need to know whether something is temporarily restricted or if it's permanently restricted and why, and keep track of that. Okay, we're going to the next slide.
Right.
Okay, organizing documentation, ask for audit request lists. So, as auditors, right, we always request or give you a list of things that we want to see, whether it's in Excel or Word. Some CPA firms use audit portals too, and making sure you have access to that to make sure you're getting everything uploaded on a timely basis. Maintaining a central folder such as audit folder to save documentation. So that, I think that's really important, and it can be a lot of different things that that you need at the end of the year. Just making sure you're organized and you're making sure you're getting all of that saved during the year. So when it comes to the end of the year, it's not a big deal. It's all there. So ensure documents are current and accurate, and clearly label the documentation.
Adding on to this, while we do want to receive all of our requested support, 8 a.m., the day the audit is scheduled to begin, some things are more important than others. And God forbid something happens and you don't have the time to prepare, ask your auditors. We can prioritize a list and say, we need this by Monday, this by Tuesday, this by Wednesday, to help you kind of decrease some of that urgency and panic in that week leading up or weeks leading up, so that you know what should be number one, number two as you go through that list.
Okay, so continued the organizing the documentation. So compiling backup of deposits, your checks received, backup of ACH deposits via the bank statement, and saving support electronically in accounting software. So this is auditors love this part, right? So in QuickBooks and probably other software too, you can actually, as your accounting people are going through the different areas, whether it's, deposits or the invoices, there is a feature in QuickBooks to be able to save all of that documentation in there. So that, and we typically as auditors ask for, accountants access to your QuickBooks so that we can get in there. And how wonderful would that be is that we can click on a document or a transaction and just be able to pop up the backup for it without having to ask the clients to pull this stuff for us. That's fabulous.
Saves a lot of time.
Okay, so now the next part, and this came from Christine, and somehow I got talking about 990s now. I'm not sure how that happened, but we have contributions over $5,000. So this is just something, to keep in mind when you'll get a client list for the audit, but usually attached to that or subsequently we'll get another request list for your 990 preparation. So, we put this in here. So any contributions over 5,000 for Schedule B on the 990, you'll need to go through and sort that, giving the name of the donor, the address, a copy of the check, of the letter, and a copy of the check or the bank statement showing the ACH deposit. So that's just something that we on the accounting side typically gather so that the 990 can be done efficiently.
Auditors do appreciate the copy of the letter though, so we can read it to see if there's any revenue recognition implications.
Or restrictions.
Or restrictions.
Yes. Okay, compiling backup of expenses. So again, having all the vendor invoices available, or vendor receipts. Again, saving the support electronically into the accounting software is always a great way to do it. And then support for all new fixed asset purchases. So, as I talked about that before, having that support, whether you guys do it or the auditors do the non-attest services for maintaining that.
Usually there is an aspect on the expense side of invoices when we're doing our audit testing should be authorized. So if you're going to save an invoice, save the copy that has, the proper authorization or signature saying, yes, go ahead and pay this. Same thing, you should save copies of the checks that have these proper signatures on there as well.
And sometimes you may use a payment system called, like there's one called bill.com. And, that actually gives you a lot of control in there because you have somebody inputting the invoices and you have an approval process right into that software so that, you don't have to have it on paper. You can see within that system that the appropriate approvals are being met, and sometimes you may set like dollar levels for approval of payment of these. Okay, so we're going back to the 990. So fundraising events. So Schedule G on 990. So again, we kind of talk about this. Angela and I even talked about this before with our first session. Is having the revenue per the event and then the expenses per the event. So just having those because we may be netting it on the financial statements, but it depends on the situation.
And listing out your different fundraising events can help us determine if there's any in-kind expenses, which we will talk about more.
Okay, having all of your current contracts available in the audit folder that you've created. Having the signed and notarized contracts. Again, we like to see contracts that are signed and actually can't come up with the word. Executed. There we go, Charlotte. Executed contracts.
See, I'm listening.
A lot of times, clients will give us like contracts or loan documents or something that, there's no sign that it actually was executed. So, we really appreciate that when we get those. The list of grantors, name of the grantor, the address, the entity type. Some of that may be for purposes of confirmations, accounts receivable, grants receivable, if we need to do some of that.
And with the contracts, saving the vouchers, if they're expense reimbursement, cost reimbursement grants, and you need to be submitting vouchers to the granting agency, make sure you're saving copies of those vouchers. And whether we may need to know timing, you may not submit a voucher till after year end, but it's related to, say, your December year end, it's related to expenses incurred in November, but you didn't ask for reimbursement till March. That should really be a receivable on your books as of 12/31 because you incurred the expenses and you're due that revenue.
Oh, yeah. Polling questions coming up. Okay, so how does your organization save records? Hard copies only? We don't save them. It's a major red flag for our audit. Electronically, and they are all over the place. So we have 29 seconds.
Electronically is my preferred. Electronically and hard copy is even better.
Hopefully that, if they're doing it electronically, well, on their system, they're also saving hard copies.
Yeah. A few seconds left in this poll.
And how does this?
Perfect.
Perfectly, 65% electronically.
Which means they're ready to be attached right into your transactions if you use QuickBooks Online.
Or put in a portal or put in our link. In our share file links that we use. Okay. So again, talking about organizing documentation, statements and reconciliation reports for your bank accounts. for your investment accounts, loan statements, the credit card statements, and the line of credit statements. So you're just having all of that available is great so that we don't have to ask for it. Okay, so payroll. In this, I can definitely tell it's coming from my accounting department because I know what they like to see. So when we're doing the accounting work, we save the payroll reports per pay period. We get the quarterly 941 reports. We get at the end of the year the W-2s and the W-3. The earnings of all employees through audit period. Any compensation paid to board members, which will be needed for the 990. Benefits paid by the organization for the executive director. And then the 1099 NEC filings for the audit period. So these are a lot of the things. So some of these things like, when we're as auditors reconciling, a lot of times we will ask you guys to do a 941 reconciliation, which takes the wages that were recorded on the 941s and reconciles that to your general ledger wages. And there could be accrual reconciliations, there could be some tax issues and different things that could create a reconciliation, but we typically ask for that. And I know like in my accounting department, we typically do that for our audits.
Other things with reporting or with payroll, saving any authorizations if employees are, your annual raises, saving some type of documentation to support that those raises were authorized, as well as kind of HR compliance, making sure you have 1090, what are the letters? W-4s and I-9s for all of your employees as required to have. That's some things we'll usually, during our audit, we like to select a couple employees and make sure that all of those personnel files are complete. Doesn't necessarily impact the financial reporting, but it is a compliance issue that should be maintained.
Okay, in-kind donations. If the organization receives in-kind donations, it is important to track them on a spreadsheet. So this is something that I don't know how many years ago now, the FASB put out more guidance. So there's more stringent requirements in the financial statements for in-kind donations and showing the expenses associated with that. There's enhanced disclosures in the financial statements and the notes, enhanced how are you coming up with a fair market value to come up with those things, whether these items have been restricted by the donor. So there's a whole bunch of different disclosures that we also have to make. So, getting the date of the donation, the description of donated item and the value of the donated item. And this is something that you really should be maintaining and tracking throughout the year. Okay, organizing documentation continues. So policies and procedures, having established policies and procedures updated. So if you have, as part of our audit, we have to go through the internal controls, get a good understanding of what you have, how things are operating. And typically we ask the client to write up a like kind of a narrative of what you do in each of the areas. So we will ask, in the client letter, the client request letter, to go through for the client to go through and review those and make sure that they're updated if there's been any changes, that we would like to know about those changes so that when we're doing our testing, we know how things have changed and we won't be surprised.
Yeah, so these should be reviewed annually. And in addition to those four, you also want to look at payroll policies and procedures and your financial close. What is the policy and procedure for each month or quarter, annual, year end? What's being done?
Okay, other miscellaneous items, final board approved budget. So having that documentation we do during the audit, a lot of times we will take the approved budget and compare that to the profit and loss and look for any significant fluctuations and get explanations for those. Having your board meeting minutes somewhere that they're handy. We do ask for those on all audits so that we can go through and review and see if there's anything significant. that we need to know about. And the number of volunteers.
As well as any perm file, organizational documents that you have, like your handbook, retirement plan documentation.
I think this is our last one, right?
Yeah, this is the
Our
last poll.
poll question. So what do you think is the most important during the audit? Availability, communicating with the auditors, timeliness, or all of the above?
Really hope everyone selects a specific answer. There is a correct answer. This is not a matter of opinion. There is a correct one. Got about 10 seconds left. Few seconds.
Countdown like years.
All of the above.
Great
Yeah.
answers. Okay. Availability. So for our last few comments, coordinate with the auditors for a time that works for both parties. Be sure scheduled time allows for proper preparation. Typically, a week is scheduled for field work. Try not to schedule other meetings, trips, etc. Make sure you're available after the week. And there's a picture in front of that.
Of field work for any.
So really the ideal thing is if you schedule with the auditors, make sure you're available because we will have questions and making sure, because what you really want to do is get us the answers to our questions, get us all the documentation, and get us out of your hair so that we can get this done efficiently with little trepidation of the issues.
We dedicate ourselves to you for a week. We ask that you do the same for us.
So communicating with the auditors, keep responses clear, direct, and factual, provide documentation, additional explanations when necessary, redirect questions to correct persons when necessary, and ask for clarifications on questions when needed. Timeliness, try to dedicate scheduled time to the audit as best you can, respond to the auditor's inquiries as quickly as possible, and provide selection support as quickly as possible.
Kind of a combination of all three of those. If you have deadlines that you're aware of, make sure we are also aware of them so that we know we have to turn around and get these financial statements audited and back to you in a certain amount of time.
So be proactive, stay on top of the documentation regularly, create an electronic filing system to paying records, saving the deposits as they happen, the expenses, all of your statements, I think that should probably said contracts, payroll reports, board meeting minutes. And we are maybe 1 minute over, so we're good.
Yeah. Just a final comment, create a system, write it down, and make sure all of your employees know the system and are following it.
All
And
right,
that's all.
excellent. Thank you. Very informative.
Thanks.
I'm very confident when we come out and audit all of you guys, you're going to be on the straight and narrow path based upon their recommendations. Actually, our clients are already all there because we've trained you very, very well. We appreciate that. So this concludes our program for today. Thank you so much for spending the morning with us. We hope you found the sessions informative, practical, and valuable to your organization. As a reminder, all the presentation materials will be available on the resources page on our website, and you'll receive a follow-up email with a download link. Please be sure to check out of the Conference.io app if you are still checked in. And if you can, please complete the session evaluation. We recognize that there were quite a few issues with Conference.io. We have tested this and used it for a year now. We're not really sure what happened today, so we do apologize, but thank you for working through this. If for some reason within the next 5 days you do not receive your CPE credit form and you believe that you're owed CPE, please just send us an email right here at reachus@DMCPAS, or you could reach out to me, Charla Roth. Thank you again, and we wish you a wonderful rest of your day.